Good morning. It is Friday, September 23rd here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Brad Smith. Brian Sozzi's on assignment. He will be back with us on Monday. But let's take a look at what's going on with the futures. A rough end to the week is what it is looking like this morning. We are seeing Dow futures point to a lower open here, down by 400 points right now. S&P futures off 1.4%. Nasdaq futures down by 1.3%. If we look at the 5-day chart, Brad, we have seen that this week obviously has been rough. Post-Fed, pre-Fed, but really post-Fed, the loss is accelerating.
Yeah, if we can pop back over to the S&P 500, actually, I know we were taking a look at the futures there, but maybe we can even just take a look more broadly at the S&P 500. Yeah. Yesterday, we had actually taken out some of the July lows that we had even seen, and so now getting even back into that territory, looking at this broader kind of year-to-date view, that's exactly where we're going to be keeping close tabs on from this point. You're seeing that July low that we had ultimately retested yesterday, and we'll see exactly where things net out at the end of today's trading session. But again, we've seen more of that slippage. The dippity dip is my key technical term that we've continued to see resurface over the past couple sessions here. But all of that triggered not just on, of course, last week where we were seeing some of the economic data that was moving into the Fed's decision, but that Fed decision, of course, that you were mentioning this week, and ultimately the pathway forward from here that they've set forth as evidenced through the dot plot data as well.
Yeah, and let's take a look at bonds just to put a fine point on that with the 10-year T-note, 3.75%. So here's the year-to-date chart, and the last time we've been there, I don't know how far we have to go back. So it's not the 5-year chart. Maybe it's on the 10-year chart, not on the 10-year chart. Maybe it's on the 20-year chart. Yeah, there we go. It's on the 20-year chart. So this is the lowest that we have seen, or the highest that we've seen, that 10-year yield going back, just eyeballing this. Looks like financial crisis times.
Yeah, 2008, 2009, right in that ballpark there. So continue to keep a close eye on that. Here are 3 things that you need to know right now as we begin today's show. We've got quite a few notes, including one from Goldman Sachs cutting its S&P 500 year-end target to 3,600. This is down from its previous forecast of 4,300. As part of its reasoning, Goldman Sachs says that the interest rate path is now higher than it had originally forecasted there. And this is extremely noteworthy, especially as we think through where banks have continued to monitor not just what their forecasts were prior to and coming into some of the most recent waves of Fed decisions, but what could also be some of the catalysts as well, especially as we've already seen some of the global picture and that global slowdown really impact companies. And there's this larger question of, with the targets that the banks are setting forth now, and especially from Goldman Sachs here on the day, if the companies that have even provided enough of that kind of forward guidance that actually reflects the real state of how their end consumers are feeling, how their business is going to have to navigate this near-term period where we are continuing to see some of that margin compression. That is going to be exactly what gets priced into even more of the year-end targets. And the question is, what type of equity market activity do we see to that point once we get to the end of the year, and the slippage that we've seen even now, because right now we're sitting at this point in time for the S&P 500 still off of some of those targets, sitting at about 3,700, just above that right now. And so to get to 3,600, there would still be even more of that downturn that Goldman Sachs foresees, and we'll see what other banks as well start to reiterate or reposition some of their own end targets.
Yeah, we've had a little bit of that repositioning already. For example, Julian Emanuel of Evercore SI cut his target earlier in the week as well. So we're starting to see this. I mean, we don't have that much more of the year to go, right, until we get to these targets. But nonetheless, it just reflects this rapidly changing environment. And in the note, I mean, basically, David Costa and the team over there at Goldman saying the expected path of interest rates is higher than we previously assumed. Yes, indeed, that seemed to be what is happening for everyone. They also said the outlook is unusually murky, and that seems to be affecting not just strategists of big banks, but companies, to your point, and everyone else. And then the other note that was getting our attention this morning is Bank of America coming out and talking about the enormous amount that people are holding in cash right now because of the extreme levels of pessimism. The strategists over there say investor sentiment is unquestionably the worst it's been since the financial crisis.
Right, and they were
dramatic to say that.
Exactly, and they were tracking some of the outflows and the inflows. Cash inflows particularly is what they were seeing there, $30 billion worth of cash inflows. However, equity funds, global equity funds, seeing outflows of $7.8 billion. Now that's the week through September 21st, and they were citing some EPFR global data. But you think about all of what would have to take place and whether we're kind of set up for what we had seen as well in 2018, where even in a rising interest rate environment back then, there was a lot of question marks around some of the sectors that could be set forth the biggest declines. And for the tech sector, and we're going to talk about semiconductors a little bit later on, there could be even more of kind of that almost similar or analogous movement to the downside in tech that we had seen towards the tail end of 2018. And what would be the backstop? What would be the catalyst for some of the companies or for some of the investors out there to start to nibble at some of those opportunities in tech? It doesn't seem to be a clear catalyst on the table right now.
Well, let's ask somebody who might be doing that. Let's continue our conversation now about the markets and what's weighing on equities and what might get people interested to get in here. That's RBC Capital Markets' Lori Calvasina, who's joining us right now. Lori, good morning. It's good to see you. So you just heard our conversation that we were having. You've been hearing about some of your peers on the street that have been lowering their forecast for year end. That dramatic comment from Bank of America that sentiment's the worst it's been since the financial crisis. What are you hearing? Are you seeing that kind of negative sentiment also?
Well, sure. And I mean, just to pick up on the Bank of America comment, like we don't really track the flows, but we do track the sentiment as tracked by the AAII Net Bull Bear survey. And we've actually been talking, for a few months now, how if you look at that survey, retail investor sentiment has been tracking down around financial crisis lows. So to be honest, that's not really new news in here. And I think that as you kind of navigate this environment, I like the Goldman comment about this being an unusually murky environment. I think we've got this challenge from the Fed on interest rates. We've got this murky economic impact. People certainly have their opinions there, but there's definitely a disconnect between expectations and what's going on in the here and now. And then, if you think about maybe potential things that could turn this market around by year end, I'd say look at the midterm elections. That was something that investors were getting quite excited about over the summer, thinking the Republicans were going to have a good showing. Typically as well, we tend to see that markets bottom in early October in a midterm election year and then rally about 7% into year end. Now that's an average. But we did hear quite a few investors talking about that over the summer, even back in June and July when they were still pretty bearish and markets were kind of dancing around those June lows. So I would say keep an eye on the election as we get closer. The kind of consensus that the Republicans are going to do well has been getting chipped away at. My hunch is that the Republicans are still at least going to take the House, and that may end up being good enough for investors, just to give them something, frankly, to latch onto at a time when valuations are probably going to start to look interesting again.
Yeah, it's always particularly interesting how the markets may cheer on logjam in Washington, D.C. or nothing happening because that just being kind of a neutralizing effort. However, I think on the other side, there are so many investors, even with kind of the neutralizing, if you were to see a logjam in D.C. or even more of a stalemate in D.C., there's a larger question of where some of the efforts that have already been moved forward in order to make sure that there are significant changes made, whether that be in energy infrastructure or whether that be in electric vehicles or in chip manufacturing and kind of quelling for some of the supply chain concerns, when that will actually start to show up for companies and be a net benefit for the major equity players that are out there that are looking for some of those supply chains to ease as well.
Well, I think on the topic of supply chains, I wouldn't so much focus on Washington and anything that's being done there. But I think if you look at our digital intelligence strategy team's work, they've been tracking a number of different indicators on supply chains that do show that things are getting better. Freight rates are starting to track down year over year. And if you just look at company commentary, a lot of companies are saying that while things are still tough versus history, they are starting to get better out at the margin. I think we had one company at our industrial conference say, everything's looking better on supply chains a little bit except for semiconductors. So I do think those things are starting to work their way into the system, regardless of what goes on in Washington in the future. And I think it will take a little bit of time for those to show up in the data on the earnings side in particular, but I do think the wheels have started to turn there.
You said in your latest note, which was your weekly note, so it came out, I believe, last Sunday, the valuations were starting to look interesting. And I guess if you liked valuations at the beginning of the week, you like even more at the end of the week when stocks have fallen by 3%. But I am curious if that calculus changes at all, given what we heard from the Fed.
So when we look at valuations, I think you look at the multiples separately, then you look at the interest rates, and then you can bake them all together. But if you just look at multiples on their own and where we've been tracking, there are a bunch of different ways you can track the PE. If you take a PE against this year's earnings and our estimate of 218, which is pretty far below consensus, we were starting to track a little bit below average at the end of last week, if you look at the long-term average in terms of how you crunch that particular multiple. Now, if you look at where the market has been trading against next year's earnings, and there we're at 212, so we're also materially below the consensus. We're one of the lowest numbers on the street there. You were still a little bit above average, but we calculated that you would be getting below average if the S&P hit about, I think, 35.61. So we're not quite there yet, but I think that is one marker you can keep in mind as you continue to see markets, sort of seize up in terms of the volatility in the very short term. And I bring that up, Julie, because when I talk to investors over the summer, again, kind of thinking back to kind of the June lows, people were not telling me that they wanted to see dramatically lower valuations. They wanted reasonable valuations, but they wanted some certainty. Now, if you layer into the Fed, I've been talking about this all week with investors. Interest rates are a good rough tool to tell you where kind of the right neighborhood valuation should be in, but they're not a very precise tool. So one model that we have that actually looks at core PCE, if you sort of bake in 4.5%, which I think is what was actually in the Fed's summary of economic projections, and that's been the kind of the consensus number in Bloomberg for a while. If you take that, plug that into a regression, and look at data going back all the way to the 60s, it tells you we should have a 16 times average trailing PE in the S&P at the end of the year. And that's actually pretty similar to what a lot of investors were telling me over the summer they thought was a reasonable multiple to pay. So I do know that, there's a lot of concern over interest rates right now and how it weighs on multiples, but I will tell you it's a weight, but it is a very imprecise tool. It's a very blunt tool, not a precise one.
Lori, just while we have you, I mean, we're about to go into the next earnings season just about 2 weeks from now, essentially. And I think about all of the companies that have either already kind of dampened what their outlook may look like for the rest of this year, or just where they're reiterating some of their guidance for some companies. But largely, we've already seen materials companies come out and kind of decrease their guidance, decrease their outlook. We heard from FedEx earlier this week and through their earnings yesterday, describing the macroeconomic outlook as well. What are your expectations going into this earnings season, and what should the results that we expect coming out of it?
Sure. So, our number again this year is at 218, and I think the bottom up consensus has been tracking around 228. So, there is definitely a disconnect, and we do think numbers need to come down. I would say, the reporting season gets lumpy sector by sector. We're probably going to hear, from a lot of financials first and industrials. Again, the tone out of our industrial conference last week was very, very positive. So I think if you hear anything other than that, it is going to be a negative shock to the system. The financials, though, if you look at kind of the setup coming in, we've been seeing pretty healthy rates of upward revisions, especially for small and mid-cap banks. So again, I don't necessarily expect anything to be bad there, but if we were to sort of see some negative commentary come in, I think that would run counter to the trend that's been in the market recently. Look, I think that investors want earnings numbers kitchen sink. They want the Band-Aid ripped off. They want realistic numbers for next year and this year, frankly, so that they can really make a true assessment of valuations. So while there might be some short-term volatility, just if we work some of these expectations down, I do think ultimately that's healthy for the market.
RBC Capital Markets, Lori Calvasina. Lori, always a pleasure to speak with you and get your perspective on what's taking place more broadly here. Appreciate it.
Thanks for having me.
Definitely. We're also watching shares of FedEx this morning. They are trading lower by about 3%. The package company announced rates for packages will increase 6.9%. This is the latest cost-saving measure by FedEx, who just released mixed first quarter results here. And they had already previewed this quarter. We had gotten kind of that warning ahead of the actual numbers dropping. We got some more color from Raj Subramaniam, who is the CEO of FedEx as well, saying that their network capacity didn't align with the demand that they experienced as the quarter progressed. Also went on to say they've taken some swift action to address what's in their control, but this really was all about volumes. Volumes during the first quarter, they saw a decline there that accelerated in the final weeks of the quarter, and the softening volumes most prominently in Asia and the U.S.
And so now it's all about slashing, slashing as many costs as it possibly can. We had already gotten, to your point, a little bit of a preview of that, right? But now we got a little more detail on exactly how much it expects to save by taking these various cost-cutting measures. So express business, it's going to reduce flight frequencies in park aircraft. We knew that. They say now that's going to save it in this fiscal year $1.5 to $1.7 billion. In the ground business, going to cut $500 million from closing some of the operations and stopping that Sunday service that we had talked about. And then another $500 million from cutting overhead, like closing FedEx office and corporate office locations. Okay, so it's taking all of these steps, which is what you would expect the street would want to hear. And yet, the street is not super convinced of this company's strategy here. The folks over at Citigroup saying that the stock could come under more pressure. We don't think management was successful in convincing investors that it has a credible plan it can execute on. And they're looking at this company in contrast with UPS, which is also raising rates, which is also cutting back a little bit, and just seeing that it's a different situation.
That is a broader hit for the consumer as well here too, because even as their data has revealed that U.S. consumer spending has slowed as inflation remains a challenge, they also talked about the change in the type of purchases that consumers are making, the cyclical shift from goods to services. What the consumer is also, and whether that's a B2B consumer for FedEx or the end consumer who is ordering something online, they're going to see a higher price in their shipping costs as well right now. And so that is yet another cost that they're incurring. And it's particularly interesting, even as I was tracking some of the emails that I received from StockX, for instance, they're passing on some of the, and businesses, e-commerce businesses, they're going to be looking across where they have to pass on that cost that they normally would take on to a seller in this instance of a single package. And so all of those things considered, that is just another headwind that the end consumer is going to have to face as well, because that's just another cost that even if it's $4 or upwards of a higher percentage that they're taking on, that is a near-term headwind for the end consumer in this entire equation of the changing fee structure from a FedEx, from a UPS too.
You're selling some shoes?
I'm not selling any shoes.
Is that what you're trying to tell us?
I'm not selling any shoes.
Oh, I thought that's what
We
I was
talked
trying
about-
to read between the lines there. You were in touch with StockX. They're charging more to ship a package, not
They are.
receive
A
one.
single one, yeah.
So
Yep.
you're not selling
I'm not selling a single
pair of
package.
shoes?
Like we were talking about during our Nike Bull Bear debate yesterday, I wear the shoes. I get the shoes, I put them on my feet, I walk around. It's fall season. It's time for me. You're going to get these shoes served. All right, everyone, coming up on the other side of this short break, Morgan Stanley is warning of a correction ahead for the chip space. We've got the details for you next. Welcome back to Yahoo Finance, everyone. The chip sector outpaced market declines yesterday and are still mostly lower this morning. A new note coming from Morgan Stanley makes the case that greater headwinds are still ahead for semiconductors due to a slowdown in macroeconomic conditions, expected to leave a big impact throughout the next year. Morgan Stanley also lowered its price target on AMD to $95 from $102. For more on this, let's bring in Yahoo Finance's own Dan Howley. Dan, when we think about some of the issues that are really getting weaved into the warnings now coming from banks in the broader semiconductor space, what really sticks out to you as of right now?
Yeah, I think from this note, at least, the big thing that stuck out to me was the industrial scale parts of the chip industry. So think the bigger companies that are going to be purchasing or normally would be purchasing chips to fill out servers and things along those lines. That's something that they said would eventually be impacted. Now, they said that the fact that we're seeing the economy kind of go south is slightly hurting these stocks. Let me just throw this out there. I'd say it's a lot more than that, because if you look at prices year to date, we're looking at the likes of Intel down nearly 50%, AMD down nearly more than 50%, Nvidia down nearly 60%. So they're all getting shellacked pretty badly here. But now they're saying into 2023, we're going to see them hurt even more as these kind of macroeconomic conditions really start to lay into these companies. So just outside of the larger issue of big name companies buying servers, buying chips for servers, and video cards for servers, you have to look at the consumer side of things as well. And we've already said numerous times that the PC market is just falling flat now from the highs that it had seen. We had Nvidia obviously announce some new chips this past week. Pricing for those is very high compared to prior versions of those chips. And at least anecdotally, from what I've seen online, a lot of gamers aren't talking about trying to scoop them up right away because of those high prices. Intel is expected to unveil their 13th generation chip this next week at its Intel Innovate conference. We have AMD obviously talking about their own chips. All of these companies, though, are running into issues in the same way. The consumers just don't want to buy right now. And that will likely continue for the foreseeable future as people decide, look, I can't spend the money on this expensive smartphone. I can't spend the money on this expensive laptop or desktop. I have to hold on for it for now. And so it's not looking good for these chip companies going forward.
Yeah, and we were talking in our morning meeting, we're going to be talking to the head of the automotive business at Qualcomm a little bit later in the show, Dan. And I think you made some good distinctions there, because it's not as though these issues are necessarily occurring across the board for different. We sort of have to look at different types of chips and what's happening with the different types of chips. As you said, the PC demand for chips probably is the most acute area of pain, I would say, for the chip makers, but they're still focusing on growth businesses like automotive, for example, like AI, for example. So can you talk to us a little bit about that differentiation?
Yeah, and that's a really, really good point. The fact that AI is still going to be a place where a lot of companies are investing. It's still, you could still call it a relatively nascent technology, just because the point that we're at with AI, it's basically a toddler trying to learn how to walk, maybe even crawl at this point. It's nowhere near where it's expected to go. So a lot of companies are continuing to invest in it just for the sheer fact that it can help them better streamline their own business practices. And I think that's going to be something that we'll continue to see moving forward. And then, as you said, obviously the car industry is a place we're going to continue to see heavy investment outside of the issue with chip shortages that continue to hurt the chip industry. There's still a number of factories and plants that have cars idling outside, or at least not idling parked. It'd be a huge waste of gas, but they're parked outside lots, just kind of sitting there waiting for components. But we will continue to see companies push the envelope when it comes to adding more and more chips to their cars. And that should help companies in that space. We're talking about, obviously, the Qualcomms, the Nvidias, even the companies that license software. So think maybe Google, which is working with some automakers, as well as Microsoft. So it could help them in that area. And look, electric cars, obviously, that's the big thing that everybody talks about. But part of the electric car equation is also the self-driving car equation. We're still decades away from actual self-driving cars, but we are seeing the technologies improve. And every time a new technology gets put into a car, it needs a processor.
Yes, good point. And they're going to need a lot more of them coming up as well, which is what a lot of the chip companies are banking on. Thanks, Dan. Appreciate it. Coming up, Costco posting higher sales despite inflation concerns for consumers. We'll break down that report and get to the opening bell on Wall Street next. Shares of Costco, we're watching those after the company reported fourth quarter results. They did come in slightly better than estimates, but the shares are down 2%. Costco noting a contraction in gross margin for the quarter, that seeing pressures from higher commodity prices, wages, and transportation costs. And what's interesting about this report in particular is that I think expectations, safe to say, were running pretty high for Costco.
Yeah.
This is a company that's seen as best in class and also poised to benefit as we do see maybe an economic downturn. It's seen as a value play, so people are going to go maybe rotate to Costco from elsewhere. So would see a bigger share of the dollars, but then what it's going to cost Costco, causing a little bit of concern among investors.
Yeah, and that showed up a little bit in their merchandise inventory. That was up by about 26% in this most recent quarter. But yeah, to your point, and from what we've heard from many of the analysts who we've discussed this very matter with, bulk tends to be, and bulk buying tends to be, one of the categories where consumers will flock to see a little bit of some of the easing of the pain when they are in kind of this cost-cutting mode, or at least in restricting exactly how much inventory that they are buying to be able to hold on for a long period of time. It really just comes down to this idea of shelf life and having an item that's either in the pantry or the ability to stock up and not pay a higher per unit cost. And that's where a company in Costco typically has one of the fanfare or favorability rather among the consumer consortium during an economic downturn. It was interesting though, in the best performing categories in the quarter, candy, frozen kiosks, frozen foods rather, kiosks, tire, lawn and garden, jewelry, toys, bakery and deli, all of that spells out little luxuries as of right now too. So you're working on the lawn, you're working on the garden, yes, you're playing with toys perhaps, and then additionally some of the other categories that you perhaps may be dabbling more in the DIY.
Right. One more thing to mention. There's not a fee increase coming. Not yet.
Not yet, yeah.
At least. This is something, Saz, I don't know if you're watching out there, this is something I think you had predicted that there would be a fee increase, but it's not happening yet. The CFO did say on the call, it is a question of when, not if, for that fee increase. Right. And the company does raise membership fees every 5 to 6 years. So they would be due to do so. The last one was in 2017. And we've got the opening bell now on Wall Street on this Friday. It's been a down week, as we talked about, already going into today with a decline of about 3% on the week. And we've got representatives of the Nelson Mandela Foundation ringing the opening bell here today. And as we've talked about, it's United Nations Week here in New York. A lot of nonprofits, a lot of global NGOs are in town, and undoubtedly that's why the folks from the foundation are here as well. Yeah,
certainly. All right, we've kicked off this Friday trading session, and seeing Saz enter the chat into our Slack during the show. He is watching from the airport, so he heard your Costco shout out a moment ago. The number of cardholders as well, just to kind of put a pin on that too. That actually was an increase, and their paid executive memberships, that saw an increase of about 1.2 million. That's significant because they tend to spend the most at Costco, that kind of family or larger household membership and that household card. So that really seeing some growth, representing 44% of their members and 72% of worldwide sales. It's pretty significant for the quarter here. You know, even as we're taking a look at Costco shares, down 1% here in today's activity. It's as the broader markets, the major averages are down, all in lockstep right now. You're seeing the Dow, the Nasdaq, and the S&P 500 down in the corner of your screen. We'll continue to keep an eye on that, as well as shares of Getty. You just saw those shares up on the screen a moment ago here, as this is following the announcement of its chief financial officer, Paul Carbone, resigning effective October 28th, noting Mr. Carbone will be returning to Boston to pursue a business opportunity that's going to allow him to be closer to his family. This just kind of in the slate of executive changeovers. Also, DocuSign, they named their former Google executive, Alan Thygesen, as its new chief executive officer. Alan is set to assume this position effective October 10th, along with a role on DocuSign's board of directors here.
Okay, well, let's talk about DocuSign first, and then let's talk about Yeti a little bit more. DocuSign, really interesting here because we know Dan Springer, who friend of the show when he was in that position there at DocuSign, really struggled post-pandemic. He kept trying to sort of tweak the sales pitch for the company, the sales force, how they were approaching sales, and it never quite gelled, at least not this year after that huge growth during the pandemic. So there was an interim CEO there, Maggie Wilderotter, who was on the board, and they were doing this search. And now it looked like initially there was a positive reaction here to the new CEO. It's gone away a little bit, but definitely he has a good pedigree and background in terms of his history at Google.
Yeah, you know, it's interesting because we had also seen former executives at DocuSign have much of this marketing background. I think Dan Springer also had a lot of the marketing background that he brought to the table. So really kind of going further in line with that, Alan is now going to bring to the table that Google kind of global marketing background that he did have as well. And really for DocuSign as a business, there was so much of the pull forward in demand over the course of the pandemic, less of the physical documents that have needed to be signed in person during that period in time. And for large part, there's not going to be a ton of the physical signed documents that perhaps need to come back. Everybody has matriculated over to a DocuSign or an Adobe solution. And so now it really comes down to where DocuSign is able to sell into. They've already got this partnership with Microsoft that they announced earlier on this year. We'll see if that adds any net new clients to their portfolio as well, as you're able to tap into some of those new Microsoft constituents. And then it's really where the plugins are going to be. And I think that's where they need to have those partnerships. And that's perhaps where Alan Thygesen is also going to kind of layer in that approach over at the executive team and the strategy team over at DocuSign too.
We got to call them and figure out how to say his name. That's our.
Thygesen? Did I say it wrong?
I don't know.
I believe that was right.
Okay, Thygesen.
Yeah.
I said it wrong then. Okay. Anyway, let's talk about Yeti for just another second here. Carbone, there, I think we've got it.
Yeah, we got that one.
What's interesting here is the stock is sliding. It's already down some 60% year to date. You know, Yeti has been a public company longer than I realized. It actually came public back in 2018. He helped with that process. The IPO price was $18. So it's still trading well above that, even with this 60% slide this year. But just like we've been wondering with everything else, this is something that surged during the pandemic. A lot of people bought these sort of luxury coolers, right? They had money to spend. They were spending time outside. Then we have seen that wane. And now, as we are potentially going into a recession, are you going to buy the Yeti, or are you going to buy something on the lower end, or are you not going to buy, once you've bought it, you don't need to buy another one? I don't know. But the point is, there's been some concern about the outlook. And even though he's talking about resigning for personal reasons, the market is using this as a reason to continue to sell the stock.
This is a good Austin, Texas company, Yeti is, and I've been to their mainstay in Austin, and I mean, they've just got a great kind of brand ethos that they're able to push forward with the outdoors annexation, of course, and the durability of the product. And I guess that's also part of the issue too. When you have a product that is as durable as the Yeti coolers, you start to get into the replenishment rate conversation. How often is a consumer going to go back and voluntarily purchase a Yeti mug or a Yeti cooler, especially if it is so durable and it lasts for so long as well? That's a larger issue, perhaps. But again, that just speaks to the quality of the product. That's great, but it can also be a gift and a curse, perhaps, in some instances.
Maybe so.
As we had seen in Lululemon's case for many years too.
So coolers may not be the hot product right now. You know what's really hot?
What's that?
Primary care providers, apparently.
Smoking.
Humana and CVS reportedly interested in striking a deal to purchase Cano Health. Cano's talks with Humana appear to be serious. That's according to the Wall Street Journal. A deal could be struck in the next several weeks, and shares of Cano are up by 3%. They surged yesterday. Late yesterday is when this report came out, and they went up quite a bit. There's been a lot of deals for primary care providers, right? We had Amazon agreeing to buy One Medical, or the parent of One Medical, CVS buying Signify Health for $8 billion. And there have been activists that have been pushing for Cano to sell itself as well, including Third Point, which is Dan Loeb's firm, and Owl Creek Asset Management. Yeah,
for Cano, they've actually got a lot that's working in their favor right now. They had already updated their guidance for the full year 2022, and that was in June, so the midpoint of this year. They are looking for this membership to come in the range of 300,000 to 305,000. That's an increase from where they were sitting at prior, and that was at a ballpark of about 290,000 to 295,000. They also increased their revenue range versus the prior guidance of 2.8 billion to 2.9 billion. That's at about kind of the midpoint of there, and then also hitting still at the top end of the 2.9 billion there. So all of this considered, I think for whoever is able to get this deal through, there is a lot of growth prospect that Cano can add to their core business, and whichever parent company is able to win over this deal, you got to imagine that there's going to be a pretty premium that's attached to this deal with the type of growth that Cano is forecasting right now.
So, and it's interesting here too, because Humana probably has the biggest hand in terms of being able to buy this company, because there's an agreement between the two companies that gives Humana first right of refusal when it comes to buying Cano. So that definitely makes it more likely than not that they would be the winner.
Absolutely. All right, we got everything covered in some of the big movers here, but coming up on the other side of this short break, Yahoo Finance's Jared Blickery. He's been tracking some of the movers across the world, around the world, across the world, everywhere.
Both.
Everybody. He's here in studio, and he's going to join us next. Welcome back to Yahoo Finance Live, everyone. Major averages lower across the board here on this Friday to really wrap up what it's been a downward-facing week. Dow down by about 1%, S&P 500 by about 1.4%, and the Nasdaq in the red by about 1.3%. And this is kind of global, so let's get on over to Yahoo Finance's own Jared Blickery, who's live at the Wi-Fi Interactive. A lot of red on that screen, Jared.
A lot of red, lot to get to today. I'll tell you what, it's been a very eventful week. Another 1% down day for the markets. Let's check out the 5-day price action. At the bottom end of the range, down 4.5%. And we've seen these days quite a few times in the past. Now, here's the sector action. It should be the sector. There we go. Everything in the red here. Energy, got to focus on that for a second. Down 5%. We got WTI crude oil down below $80 per barrel for the first time since January. Just want to show you a quick trip that we've had in the XLE, and you can see right down to the bottom end of this period in early July. Also want to track what's going on in the travel sector. This has been flagging lately. You can see United Airlines, Carnival Cruise Lines, American, each down more than 3%. And you take a look at what's happening inside the Nasdaq. Fairly, not ugly, but not great either. Not too much dark red, but you can see Tesla just flashing, coming down to minus 3%. That is enough to take it into the dark red. I want to spend a little bit of time taking a look at the bond market as well. That has been really driving equities. 5-year T-note yield gapped up to a new high, barely positive right now, but these have been the moves that have been driving risk markets into the downside. And front and center in all of that is U.S. dollar. You got to take a look at this. This is a 20-year high for the Dixie. I'm going to go back to our heat map so I can show you what's been happening in currency land. We have a major political upheaval in the UK, and we can see that being reflected in the pound. Up there in the upper left, that is U.S. dollar versus a British pound, and you take a look at what's happened. Let's go back 5 years. You can see this incredible strengthening of the dollar, weakening of the pound to the upside. Most of this 23% has happened this year. So we've seen this across the board. U.S. dollar really putting pressure. And I'll tell you what, guys, we are probably one step removed from a full-out currency debasement. It's not a beggar thy neighbor policy. It's not a race to the bottom. It's simply what is happening right now. We're going to see a lot more of these big moves in FX land, and it's going to ripple across the asset classes here, guys.
Yes, it is, and also to corporate profits for that matter as well, as it has been. So a lot of big
Rosenberg warning about that today as well. Corporate profits going to take a hit.
He likes to do warning. He's a warning kind of guy.
I know. I started following him during the GFC. He's still doing it.
Yes, Dave Rosenberg is who we're talking about, ladies and gentlemen. Thanks so much, Jared. Appreciate it. Coming up, we're going to speak with one analyst who says rising interest rates are a net positive for most banks. That's next. A risk-off reality, big banks adjusting to a hawkish Fed raising rates, concerns grow in a souring market about an economic slowdown as well. Banks this week were taken to task during a Senate Banking Committee hearing over their use of Zelle and their co-ownership of that service. And so we've been watching that. On the flip side, fintechs seeing a repeat, and brokerages really seeing a reprieve in the SEC's decision not to ban payment for order flow. In other words, there's a lot going on when it comes to the financials. Devin Ryan is with us now, Director of FinTech Research at JMP Securities, a Citizens company. Devin, it's always good to catch up with you. So give us sort of the big picture here as we look at what's going on with financials, because yes, rates going higher, traditionally seen as a good thing, but on the other hand, if it's coming with a recession, maybe not.
Exactly. Good morning, Julie. So, I think right now the whole market is focused on the macro outlook, what's going to happen with the economy as a result of tighter financial conditions and higher interest rates. And so that's creating a lot of gyrations through not just equities, but all risk assets and all market prices. And so, financials are really, I think, at the center of the economic outlook. When people feel good about the economy, financials tend to do well. When people are nervous, financials are not really a defensive area. And so you're seeing that play through, I think, in the stocks right now. And no doubt there's some negative news and uncertainty in the market. But I would maybe take a step back and just talk about, what is happening longer term with these business models and also where are they trading from a valuation perspective. And so our view is that over the long term, higher rates will be positive. You have to work through some of the near term uncertainty, but earnings power actually goes up in a higher rate environment, and we think that will happen here again once financial markets stabilize, and we think they will. And then the second point is where we're already pricing these stocks. So this isn't the beginning of the sell-off. They're already down for the most part on the big bank side, 25 to 30% from their highs. Generally, in a recessionary backdrop, that's about where they go. They may go down a bit more than that, and so that's kind of our view that there might be some more downside here. But you've already priced in a pretty negative outlook, and financials on a PE basis, on forward PE, are trading at about 60% of the S&P 500. That historically averages around 80%. So you do have some value here, but at the same time, we do think you need to work through a little bit of this negativity in the market and also just get to a better consensus around where the economy is going. But longer term here, there are going to be opportunities. So I think people need to kind of keep cool heads in a tough backdrop.
Devin, we're only about 1 week away from the beginning of the fourth quarter of 2022. And then 2 weeks after that, we're going to start to get some bank earnings rolling in. What do you expect the tone or the tenor of the big bank executives to be, as they're going to be essentially setting the tone for the rest of earnings season, perhaps?
Yeah, it's a great question. I think it's important. So they have more visibility than we do from the outside. But I think, from everybody's perspective, there's a lot of uncertainty. There's a lot of I would say very smart people that have very differing opinions around what the market backdrop and the economy is going to look like over the next 12 to 18 months. And so that's a tough environment to strategically make big moves into. It's a big, tough environment to invest into. And that's the backdrop. But what I would say is that the actual business models are very resilient and have a lot of natural hedges. So we're doing some early work on firms like Goldman Sachs and Morgan Stanley heading into earnings. And the reality is that numbers are probably in a pretty good spot because on one hand, investment banking is very challenged and equity markets as of right now are down slightly on the quarter. The flip side is trading's actually doing better than I think most people have thought because some of this volatility has helped drive some activity there. So there's a lot of natural hedges. And so earnings power, in our opinion, is being affected much less than the volatility in the stocks. And so that's where over the long term, you get opportunities. But in the near term, when sentiment's negative, again, financials are not a defensive sector. So that's how positioning is at the moment. But that'll change, in our opinion. And that's where I think people that have a longer term horizon can actually selectively look at opportunities here.
Devin, you and I emailed about this next topic a little bit yesterday, and this is a little bit of a sidebar, but I do want to ask you about the payment for order flow story yesterday. Just a report for now that the SEC is going to stop short of banning payment for order flow. This has been sort of an overhang for the likes of Robinhood. The stock initially bounced, but then it closed lower. I don't know. How are you thinking about that issue and the effect that we saw on the stock?
Sure. Well, I think yesterday, the whole market was under a lot of pressure. And so you saw the fintechs take a pretty hard hit again. And I think that was really kind of what happened with the stock, is you had kind of this initial, positive reaction. And really the headline is a modest positive is the way I would frame it. Payment for order flow is about 9% of Robinhood's revenues when you look at just on the equity side. And that's really where a lot of this debate is. And so it is a modest positive headline. I think it makes a lot of sense. We've been arguing that if the SEC outright bans payment for order flow, that will actually help larger firms like Robinhood and Schwab. And we could get into that, but it'll disadvantage disruptors and firms that are trying to get into the industry and take market share. And so what this does is, I think, the SEC is still going to look for ways to increase liquidity, provide more transparency, and improve execution. I think those are all great things that should be applauded here. But the way to do that isn't taking away payment for order flow. And so I think, again, modest positive, but right now the market's so focused on what's happening today and tomorrow in this really tough backdrop. And so that's, I think, why you've seen pressure on Robinhood and some of the other fintechs that are interconnected to that.
Devin, good to see you. Thanks so much for joining us. Devin Ryan, Director of FinTech Research at JMP Securities, a Citizens company. Thank you. Appreciate it.
Julie.
Just wanted to quickly bring you some economic news here. The S&P Global PMIs are out here on the manufacturing front, coming in better than estimated at 51.8. That's the preliminary September number. Services coming in better than estimated as well, still showing contraction below 50 at 49.2. And that means the composite is better than estimated at 49.3 versus the 46.1 that was estimated. So again here, getting these measures of purchasing managers index and actually coming in better than estimated on all three measures, the manufacturing, the services, and the composite. Services still showing, as I mentioned, a little bit of contraction here, but I don't know, this is perhaps a little bit more of a positive number. To be sure, the economic data as of late has been mixed. It's not clearly sort of one direction or the other. Coming up, we're going to break down some of the calls of the day today, including an upgrade to Dominoes Pizza. That's next.
It's Friday, so it's time for a pizza party. We are following 2 analyst upgrades today. One for Dominoes out of BMO and one from Wedbush for Fubo TV. Let's start with Dominoes here because there's a lot to really look into here, particularly as we're seeing the stock react by about 3%. They've set a new price target. $430 is that new price target, and they've got an outperform rating on the stock. There's been a lot of chatter around Dominoes over the past couple sessions. We had also seen even more from Deutsche Bank. They had lowered their price, actually. Their price target now $373. So kind of some mixed reviews here coming in on the pies, if you will. But this larger kind of annexation to some of the kind of restarts of social functions and events. Domino's Pizza, of course, continues to be one of the core brands that is a net beneficiary of events coming back together, the start of football season, even though the partnerships with different leagues, those are highly coveted partnerships. And for Domino's, it's a larger question of how will they continue to navigate through everything from some of the input costs for just making a pizza or menu innovation, perhaps? All right, well, we won't get into the menu innovation conversation here today. But I think for Domino's and where the mixed takes have been, there's still a lot of opportunity for leaning into the digital customer and that annexation that they've really pioneered that connection point in the pizza category with too.
What do you eat when you're watching football?
What do I eat when I'm watching football? Usually wings.
Pizza?
Wings,
Pizza.
I love tater tots. I love tater tots when I'm watching football.
See, I don't think about pizza and football in my brain, but I'm not a football fan, so I think about wings and football.
Yeah,
Or like nachos and football.
Nachos and football, that's good. My first ever job was actually at a sports grill where every Sunday people would just line up, get the wings out of Westchester, Pennsylvania, Stadium Grill, and I was all about the wings there.
Oh, I'm getting an affirmation from our producer who is a big football fan. Nachos and football is good. Thank you very much, Val. Let's talk about that other call real quick here that we had on Fubo. Speaking of football, on Fubo TV here. This coming from Michael Pachter over at Wedbush, who is upgrading this to outperform from neutral. The stock is really plunged this year, so part of it has to do with valuation, that there's an attractive entry point here. According to Pachter, Fubo TV has a solid head start in offering live sports programming to its subscribers, thriving and growing advertising business. The issue with the business has been cash burn, and so he talks about that the company needs to focus on raising capital and cutting its cash burn to extend its cash runway. He says, we're confident the company can do both, although there could be some dilution from any kind of capital raise.
Get you a streaming service that can do both. I mean, at the end of the day, for Fubo as well, and I think they make a great point when it comes to the sports rights and being able to have that streaming capacity. Sports is going to be a major kind of opportunity that Netflix is not going into getting sports licensing outright. Sure, there are other ways that they're trying to backfill for all the lost 30 for 30 content, but at the end of the day, for the sports rights that have been continued to be either competed for or whether that's by an Amazon and Thursday Night Football or whether that's even by an Apple, which we'll talk about a little bit later on, I think there's so much opportunity for the annexation of streaming to sports. It's really just a matter of how much all of these brands in the streaming space are willing to pony up for that new customer acquisition and hoping that they'll consume some of the other content that they're paying millions, if not billions of dollars to produce over time too.
Yes, indeedy.
Yeah. Guys, coming up, which housing markets are holding up the best and I guess on the other side of that, the worst? We'll break down that with UBS Home Builders Analyst coming up next. Welcome back to Yahoo Finance on this Friday. I'm Brad Smith alongside Julie Hyman. Brian Sazi is on assignment. We'll be back next week, though. About 30 minutes into the trading day here on this Friday, let's check in on the markets. Not so yay there. In fact, it's a nay. Now, Dow Jones Industrial Average has slipped lower, and it is down by about 1.4% at this point in time, 428 points in negative territory. The S&P 500, you're also seeing that down 1.8%, and the Nasdaq Composite also lower by 2% for the tech-heavy average. We're going to continue to track that very closely, and coming up in this hour as well, Qualcomm revving up its partnerships, announcing a deal with Mercedes-Benz for its upcoming vehicles. We'll be joined by an executive from the company. And one of the largest U.S. crypto exchanges getting a major leadership change. We talk with Dave Ripley, who has been tapped as the newest CEO of Kraken. And Yahoo Finance's Brian Sazi caught up with Slack's chief product officer and talked all things return to work. You do not want to miss that. But first, let's get on over to Julie Hyman at the Yahoo Finance Interactive.
Hello there. I want to start with oil prices, actually, because the move that we are seeing today is fairly remarkable in oil here. Right now, down almost 6% for WTI, below $80 a barrel. So that's the first time we've seen going below that threshold in quite some time. Here you have the 3-month chart for crude oil prices. And this is really feeding over into what we are seeing in terms of the groups within the S&P 500 as well, as I'm trying to figure out how to get us to the sectors here. I'm going the wrong direction, apparently. Here we go. As we go down to the sectors, we are seeing energy stocks really under pressure here. Energy stocks down about 6% right now. They were down as much as 6.4% as a group earlier in the session. So this, again, I really want to put a fine point on this. This is the best performing group of the year. We have been seeing oil prices slide. Gasoline at the pump has slid, as we've talked about before, for 100 straight days before pausing in that slide. But if this is any indication for what we are seeing with oil prices and energy stocks, we could continue to see a cap on gasoline prices by extension. Here's the year-to-date chart. It's still up 28% for the year. So really important move here that we are seeing today in energy prices, really a breakdown in these stocks. Consumer discretionary also under pressure today. That's the year-to-date. It's exactly the inverse, down 28% and still down today. And then real quick check on material stocks, down 25% year to date and under pressure once again today. And let's talk more about that group, materials and home builders for that matter, because we've been talking a lot about the recent housing numbers and the softness that we've been seeing as we have seen sharply higher mortgage rates. For more on all of this, let's bring in John Lovallo, UBS home building products analyst. John, thanks for being here. We heard from some of the home builders recently. We've been getting home builder confidence numbers that are not great here. There are so many constraints on these companies' business. Let's start with mortgage rates here and how you view the trajectory here. Do we continue to see pain all the way up as mortgage rates continue to go higher, or at some point do consumers make an adjustment?
It's a great question, and thanks for having me. I would say that historically, when we have seen these sort of sharp moves in rates, there's always an adjustment period. It takes time for consumers to realize that, hey, we're not at that 3.25% rate anymore. We're closer to 6.25%. But let's take a step back and see what we can do to make things work. And there's a lot of levers that the home buyer can pull. You think about the first-time home buyer in general. I mean, you can move to a smaller footprint, further away from city centers. There's a huge in-migration trend in the U.S. where folks are moving into the Sun Belt, into lower-cost areas. There's a massive wealth transfer that's going on in the U.S., $68 trillion being channeled from baby boomers to millennials and Gen X. And there's a lot of student debt relief going on, and even more in the pipe. There's been $25 billion so far. So things are tough when rates move very quickly. There will be a reset period, and there are a lot of levers that can be pulled.
Okay, and so there's a lot to break down even within that. So I guess starting things off with where home buyers do have any type of leverage, because for the builders, the confidence, that has sputtered. We've seen that slip for consecutive months. Where, I guess, are home builders going to start to see some of their confidence return? And it seems like some of that, or much of it, is directly hinging on some of the supply chain concerns also alleviating themselves.
Yeah, really good question. I mean, there's a lot going on in the market right now. Consumer demand has certainly moderated. That's to be expected given what we just talked about. But there are lots of supply constraints still in the market. The fact that builders getting land even zoned and entitled has taken a tremendous amount of time, much more than it would historically. So what does it take to get builders confident again? It's a good question. I think that, one, we're starting to see some easing in the supply chain on the margin. So that will certainly help. And the moderation in demand is going to also help that. But I think what's interesting on the consumer standpoint is that we've seen over the summer months, and this was actually reported by both KB and Lennar yesterday that reported, that we've seen improvement, at least sequentially, through the summer. And the summer is historically a slower time. So this is really unseasonal, the strength that we've been seeing. Now, it's not great, but we are seeing a little bit of signs of improvement, which suggests perhaps that the consumer is getting a little bit more comfortable with rates.
John, we talked earlier in the week to the president of the National Association of Home Builders, and granted, his realm was much more political than yours, but he did interestingly point the finger at policy in part as being to blame for some of the weakness in the housing market in terms of zoning not being more favorable, for example, and also, of course, the effect that the Fed has had on interest rates. How do you view those issues and whether anything's going to change on those fronts?
That's a tough one.
Yeah.
I think that there are certainly some restraints that have been put into the market in terms of regulation, whether that's on the land side or just zoning in general, and that's a challenge across the board. I mean, I think on the margin maybe it's gotten a little bit worse, but I think it's always been somewhat of a challenge. In terms of rates, I mean, Powell's in a tough spot where we need to get inflation down, and I think that they're he and his team are doing the best to kind of manage that. Where rates go from here, it's very difficult for us to tell. But at the end of the day, people need homes, and there's still homes that are sold, and I think that will be good for the home builders over time once we can kind of get a little bit more comfortable with the current environment.
That's really interesting because previously there was this advice to prospective home buyers to wait for this pivot in Fed policy. But now that we know that the pivot has essentially paused in any type of fodder for conversation, where are we going to see home builders home buyers rather? Should we see them? Should we expect to see them kind of rush in to try and take advantage while rates are lower before they get even worse?
Perhaps. I think right now, though, we're still in that adjustment period where we saw about 140 basis points of rise, since late summer. It's really been sort of unprecedented times. So I think there is a reset period that's going to need to happen. Now, will folks rush in and try to, beat the next leg up? I don't know that anyone knows the answer to that because no one really knows the direction of where rates are going. And I think that's a big challenge for not only home buyers, but for investors in the stock is we don't know where rates are going. So it's really tough to figure out what you're underwriting when you're buying, agreeing to buy a home or buying the stocks.
John Lovallo, UBS Home Builders Building Products Analyst. Thanks so much for the time this morning. Appreciate it.
Thanks for having me.
Definitely. Everyone, let's take a look at a trending ticker right now. Take a look at shares of PINS, pins, down 4% right now after reports from Deal Reporter saying the company's largest investor, Elliott Investment, may push for a sale. Elliott's involvement with Pinterest was reported back in July by the Wall Street Journal, which said at the time that the firm had built a stake of over 9% in the company here, Julie. This has been really interesting to track in terms of what Elliott's ultimate goals were with that stake that they had built up in Pinterest.
Yeah, what's interesting is that the stock is not going up, right? We had a little bit of a spike earlier in the session when this first started percolating out there. This was reported by Deal Reporter, which is behind a paywall. So then it sort of trickles through, right, the system and the chatter among traders. But you would think if Elliott's pushing for a sale, that Pinterest would be higher. So the fact that it's not maybe throws a little bit of skepticism into the equation or questions about if they were going to sell themselves, who would buy them.
It is, and it's a question of, as well, what category still Pinterest wants to play in. It's not clear. The company was trying to step away from being annexed to the other social media companies at the time when it went public. It's still tried to be, and largely has been, kind of this inspirational platform for finding out new things that you might be interested in, and whether that's DIY projects or whether that's just finding new recipes or just finding inspiration for everything from your next outfit that you want to wear all the way to the way to kind of propagate a new plant. And so all of that has now gone increasingly to some of the other social media platforms that Pinterest didn't want to be annexed to. So it's a larger question of, for whoever would be that acquisitive company, the company that would come in and swoop in and ultimately kind of put them under their umbrella, what vision they have for growing out Pinterest and that average revenue per user on the platform too.
Right, lots of good questions about all of this, and like, would it be someone in e-commerce who could link up and monetize all of those different? I mean, they've done some of that already, right? A lot of the Pinterest stuff has links, but I don't know.
We'll have to continue to watch shares as we move on throughout the day. Yeah, coming up, Brian Sozzi spoke with Slack's chief product officer at the Dreamforce conference. We're going to share that interview on the other side of this short break.
Let's get down to business now and take a look at some of the other headlines that we're watching. Boeing set to pay $200 million to settle charges by the Securities and Exchange Commission that Boeing misled investors by making false statements about the 737 MAX's safety risks while under the leadership of past CEO Dennis Muilenburg. SEC Chairman Gary Gensler saying in times of crisis, it's especially important that public companies provide fair, truthful disclosures to the public, and Muilenburg failed in the most basic obligation, Gensler said. Muilenburg will pay the securities regulator $1 million to settle the agency's claims. Tesla recalling over 1 million vehicles over window finger pinching concerns. Tesla says the automatic window reversal system may not react correctly after detecting obstructions, according to safety documents posted by U.S. safety regulators, and that is a violation of federal safety standards. Tesla discovered the issue in August. It will roll out an update to fix the problem. The company also filing a countersuit, meanwhile, against the California Civil Rights Department after that agency accused it of fostering racial bias in its Fremont factory. Tesla says the agency did not give adequate notice or earnest engagement in efforts to resolve violations. And it's official, Apple Music is replacing Pepsi as the primary sponsor of the National Football League's Super Bowl halftime show. It'll begin with Super Bowl 57 in February. The Super Bowl, usually the most watched TV event of the year, with over 120 million viewers tuning into this year's show. Though terms of the deal have not been released, it's expected to become a key platform for Apple, which has been a key player in music since it introduced the iPad in 2001. Apple's also among a number of companies bidding for the NFL Sunday Ticket. DirecTV's deal expires at the end of this season, and this is reportedly part of the ongoing negotiations between Apple and the NFL that it is getting this sponsorship deal for the halftime show. Coming up, Qualcomm is revving up its investment in the automotive space. We'll speak with the company's automotive senior vice president next.
One of the largest U.S. crypto exchanges is getting a major leadership change amid the current meltdown. Kraken's CEO, Jesse Powell, stepping up to the chair and that of the exchange's board. In that role, he's going to oversee product and dip his toes into advocacy work after finding himself in the hot seat due to insensitive comments and a poor corporate culture. Joining us now is Kraken's COO, Dave Ripley. He's been tapped to succeed Powell as CEO. Good to have you here with us today. First and foremost, the leadership changes coming after a time where corporate culture has certainly taken a hit. So with all of this in mind, what is the company and the executive team trying to signal to the team, the employee base, even amid so much of the challenges that the broader macroeconomic environment have presented?
Yeah, well, thanks for having me on here. I think a couple things there you wanted to touch on. So culture and then the broader environment. So first of all, on culture, Kraken's culture is thriving. It's amazing. We just recently, of course, did some great work articulating and codifying our culture, and we released that publicly. And it's been a resounding success for us. On the heels of that, we launched our annual engagement survey, and across the board, we're above industry rankings on almost every category to a considerable degree. So, just a fantastic set of team members, Krakenites as we affectionately call them. So culture is in a fantastic place, and we wouldn't make this move if that wasn't the case. On the broader market, for sure, absolutely. It's probably a crypto bear market here, but this isn't our first rodeo. I've personally been through 3 bear market cycles in my time in crypto. And this one more than ever is an opportunity for us. We've been doing a great job of adding new talent to the team as the recruiting environment gets a little bit more amenable to opens up a bit more, and have been focused on scaling the business, scaling the product operations, and all these types of things that we have an opportunity to do while the market plateaus here. So we're really excited about the opportunity to catch our breath, to really fortify the business and get ready for some significant growth to come.
Dave, I'm just curious. I know you've been around with Kraken for a while, and so between this leadership shift, is there any meaningful change the company will see that you want to speak to? I mean, I know obviously the company has been talking about doing something like an IPO for years. And
sure. Yeah. So great questions there. So, first and foremost, I'll just hit on the similarities. Kraken is incredibly mission driven. Our mission is going to remain steadfast. Our values and our culture, they'll remain unchanged. And this is the constant. But you're absolutely right. Look, Kraken is, since the time I joined, we were 50 people, and now we're over 3,000. So, as we look forward to grow, we will have to change and adapt, and we'll have to scale the business and, look to operate differently, ideally keep some of that innovative and entrepreneurial potential. But, frankly, scale and meet the challenges of a larger organization. So that's undoubtedly going to be the case. And then with regard to, IPO and fundraising, for sure. So we, are always, kind of top of mind with regard to our capital structure and where we sit. We have a strong financial position, balance sheet right now. We haven't actually tapped capital markets and fundraising significantly in Kraken's past relative to our peers, if you will. But it's absolutely something out there that we could, look to fundraise in the future. And, whether that be private or public is, something that would be TBD.
Dave, I got to say, there's a lot going on at Kraken. I mean, we talked about the cultural issues a little bit. You guys are reportedly under investigation from the Treasury's Department of Office of Foreign Assets Control over potential sanctions violations. The former CEO told people to leave the company if they didn't like the culture of the company, if they didn't like what he had to say. And a lot of people didn't like what he had to say. Did you guys have an exodus of people? Are you now, as you're rebuilding and changing the culture, are you trying to hire a lot of new people if those people left to replace them? It's from the outside looking in, feels like there's a lot of turmoil there.
Yeah. Like I said, could not be more inaccurate on that last piece there. So, I'm not too sure how else a company would want to operate other than to clearly articulate their culture and ensure that people that are part of the company are actually happy there and want to be part of the culture. And that's exactly what we did. I'm nearly certain in the absolute dozens of companies that I've worked with, public companies, Fortune 500 companies that, those with the, kind of like the strongest mission and culture are the most successful. And that, that's definitely Kraken. And so, upon articulating our culture, we did actually take the step to say like, hey, if anyone here isn't on board with this, we're happy to help you find your next opportunity. And
so did people
that's
leave?
What we did. Yeah, it was about a fraction of a percent. So a little less than a percent of the total. So it was something just under 30 people, and we have about 3,300 total in the company.
Yeah, Dave, turning towards the staking side of your business, which has gotten a lot of attention since Ethereum just sort of transitioned to proof of stake and it's created this whole staking industry. I wanted to ask, have you seen any significant changes with your staking business since the Ethereum merge. I've seen a note from JP Morgan that sort of pointed out that Ethereum staking hasn't really grown as much as was necessarily anticipated after this merge upgrade.
Yeah. I don't know if we expected any kind of like instant change or growth in, total assets staked due to the Ethereum merge. But we do think it'll continue to grow over time as of course, the network moves through this transition from wholly proof of work to, wholly proof of stake. There's still time left on the overall transition until it's like fully complete. And so, yeah, we expect staking balances to grow as a share of the total. I mean, in the end, it won't be that all 100% of Ethereum tokens are staked. For a whole host of technical reasons, the network, of course, wouldn't function if that was the case due to lockups and so forth. But yeah, we expect it to grow from here and continue to. We see kind of like the same continued growth that in Ethereum staking that we've seen over the past 6 months.
Dave, you were reportedly valued at $11 billion in midsummer this year. The crypto markets have taken a massive plunge even since that point in time. How has that impacted the company's valuation, the cash positioning, and even as you're kind of looking across where crypto in the broader kind of buildup of some networks and the still speculation and speculative asset that many investors look at it with, how does that directly correlate to the company's value itself?
Yeah. So we of course don't know definitively, right? Kraken's a public company and there isn't necessarily, a private company, and there isn't necessarily price discovery on the valuation of the company in real time. And so, that's something that, will come about when we do subsequent fundraises or, someday if the company's public, that would be the case. Do
you need to raise funds right now?
We don't. We don't. I mean, this is, on your second piece there. Yeah, we have a, strong financial position. The broader, drawdown in market caps of companies, of course, don't impact our balance sheet at all. So, that remains unchanged from that standpoint.
And a quick follow-up on that, Dave, we've seen some other exchanges going out and making acquisitions, right, in this environment. Do you guys see yourselves doing any of that?
We do. We have, a strong and fully built out M&A team, and, they're active. We did a significant acquisition of a company called Staked to really fortify our position in the staking market less than a year ago. And, we're kind of continually looking for acquisitions, primarily a lot in, new product and tech within the crypto sphere that makes sense to add to our portfolio.
Dave, thank you. Dave Ripley, and thanks to Dave Hollerth as well. Appreciate it, guys.
Yep. Thank you.
Well, turning now to the world of semiconductors. Qualcomm is revving up its partnerships, announcing a deal with Mercedes-Benz for its upcoming vehicles at its Automotive Investor Day. The chipmaker also announced the expansion of its automotive design win pipeline to $30 billion. Joining us now to discuss, Qualcomm Automotive Senior Vice President and General Manager Nakul Duggal. Thank you so much, Nakul, for being here. Looks like investors, when you guys made this announcement yesterday, were pretty pleased with the results. This was a bigger than expected pipeline than they were looking for, right? So talk to me about the process here. I know that automotive is about 12% of your sales or so right now. What are you guys pushing towards here in terms of goals?
Good morning. Thank you for having me. Look, we had a fantastic investor day. The auto industry is betting on the Qualcomm Snapdragon digital chassis platform, which we are working with a large number of automakers on. As the industry goes through this massive transformation that is upon them, every car company has to very rapidly become a technology company. And Qualcomm is being selected by a variety of different automakers globally as that technology partner of choice. We expect rapid transition in terms of how the market evolves when it comes to automated driving, digital cockpits, connectivity. So the definition of the new car of the future is going to require this shift in technology adoption, and that's what we are driving.
Is that total addressable market based on clients, customers, partners that you're already working with, or is that also in competition where you're going to seek to take on a certain extent of the market share of that total addressable market? And if you can kind of parse through some of your competitors that are also going to be really competing for that, how that really looks like and how ready you are to accelerate that too.
Yeah, so we have been, consistently and patiently investing in the space. There are a few things that are absolutely evolving. One is the silicon and the software content is rapidly expanding in vehicles as every vehicle starts to become software defined. That is certainly a big accelerant in terms of the addressable market. I think the other big shift that is happening is that automakers are making direct bets on technology partners that they want to be able to work with over multiple generations. So, sitting here today in 2022, we are involved in decisions for production years 26 and beyond. And this is why we are actually able to provide visibility in terms of what the business starts to look like over the rest of this decade, because the pipeline that we announced is actually providing us that coverage over an extended period of time. We've shared the $30 billion number, but we are essentially seeing a rapid transition in the market in terms of making these technology bets, and that's how we are able to go forecast that larger addressable market.
Nicole, I want to ask about supply chain for a moment here. Now, I know you guys aren't fab, you're designers and licensors, but nonetheless, you're affected by what's going on in supply chain. We're hearing from the likes of Ford that they've got 40,000 to 45,000 unfinished vehicles sitting around. Is any of that because, or not Ford specifically, but are we seeing still issues with getting automotive chips into vehicles?
That's a good question. One thing that Qualcomm did early on, right at the beginning of the pandemic, was we prioritized automotive supply above all other verticals that we are involved in. So we wanted to make sure that none of our customers were impacted by the supply chain crisis on account of anything that Qualcomm was shipping. Now, obviously, automakers put in a variety of different semiconductors that have a various set of dependencies across a fairly complex supply chain. We do see that the supply chain complexity is going to improve over the second half of next year. We ourselves are not necessarily seeing any specific challenges on the products that we supply into automotive.
Nicole DeGaulle, Qualcomm Automotive Senior Vice President and General Manager and owner of a Birds of Paradise and Monstera plant behind you there. Appreciate it.
Thank you for having me.
Guys, coming up, Brian Sazzi spoke with Slack's Chief Product Officer at the Dreamforce Conference. We'll share that interview on the other side of this short break. The Dreamforce conference is all wrapped up in San Francisco, which means Brian Sazi is on his way back to New York. Before he left, though, he sat down with Slack's chief product officer and talked all things return to work. Take a listen.
We've been working very closely with our customers to understand what they need, and some people are coming back to the office. Some people are working in this hybrid situation, and some people are fully remote, but what we find is they all need the same thing. They need to be able to collaborate effectively and to have tools to increase productivity.
What is the next generation of Slack?
So we're continuing to enhance our tools and enhance our platform so that we can build in more collaboration, more connection. People miss not seeing each other in person, and even if they are going into the office, every time you collaborate, you want to make it feel more personal, more human. So we've added into our huddles feature, which is a audio first collaboration, the ability to have video and to have fun effects and emoji reactions to make it feel human.
Do you find it weird that we still have meetings as if it was pre-pandemic?
You know, a lot has really changed. People think about meetings in a different way. The whole concept of video fatigue is you really don't like being on screen all the time. And I think people are more open to changing how they meet. And people are talking about how do we have fewer meetings? How do we have more asynchronous meetings? The word asynchronous was not a word that a lot of people used before the pandemic. Now you hear from everyone. So a lot of our meetings we've stopped having, and they've gone asynchronous with video clips. So you just eliminate the meeting altogether. So I find people are more open to change.
There's this knock on Slack that we're always on Slack. If we're on Slack, we're not maybe getting things done. Where do you stand in this debate?
So work is communication, and most of our work is communication. And you should be using whatever communication tools you have to increase more effective communication and be off the tools when you need to. When I need to focus, I turn on my do not disturb and I focus. And there's an etiquette of when something's really important and you have to respond. But people are going to use whatever tools they have. If they don't want to focus on their job, it's easy to do that with email, it's easy to do that with any tool. So you have to use your tools in a way that make you more productive, of beyond them when it's going to actually help you with your work.
Be right back, I'm gonna check my messages. No, I'm just kidding. But how do you think about, one thing I've learned or I've picked up on the keynotes at Dreamforce, talking to folks, is better integration between a Slack, a MuleSoft, a Tableau, and that core CRM software. Is that the right way to think about it? These things are finally starting to integrate and communicate with each other?
100%. Slack's platform has always been one of the key parts of Slack in that you can integrate with any third party. So in the very early days of Slack, developers used it for incident management, of integrating with all their tools. And we've really focused since the acquisition on integrating with all of the Customer 360, all of the clouds. This adds so much value to your productivity. So instead of having to leave where you're engaged and go check another tool, you get a notification right where you are, and you can actually respond with a workflow to whatever that issue is without leaving Slack. So it just increases your efficiency. So that's another big focus of ours, is automation.
How do you keep developers and your software team focused? This is a challenging time for the economy, the world, but how have you kept them just focused on the mission, on what you need to achieve?
So for us, it's all about the customer. And the closer people are in the product organization, the engineering organization, to the customer, the more motivated they are, because you see that you're helping them. Yesterday in the Slack keynote, we had some people from Janssen, some customers who are helping to eradicate cancer. And nothing could be more motivating than to make them more efficient and more productive. So if you constantly are talking about the customer and how what you're doing really has an impact, then people will focus on building the things that will help the customer.
I've asked Stuart Butterfield this numerous times about Slack hacks. He has told me a couple of his. What are some hacks that we're not using that we should start using?
Well, one that you probably don't have yet is the huddles that's coming out with the effects, which is bring people together in a video. But one of the things I use a lot is scheduled send, because you don't want to bother somebody.
There's a schedule send on Slack?
Oh my God, you didn't know that?
I didn't know.
Oh, I'm so glad
I'm not supposed
to
say that, but just an authentic moment. Like I didn't know that.
Yes, so by the little send, there's there's a little carrot that you can schedule it whenever you want. So Sometimes I catch up on all my messages on the weekend and I don't want to bother people, so I send it for Monday morning.
Wow, I didn't. And it is okay to have your do not disturb on. That's okay.
100%.
You put yours on. Like, when do you set yours?
I put mine goes on every day at 10 o'clock.
Okay.
And until the morning, I think it's 7 or 8. But every night I have my do not disturb on. If somebody needs to reach me, they can override it, but every night.
Coming up, going viral, we'll break down this week's top TikTok trends. It's a new feature from us, a new segment. Stay tuned, it's on the other side of the break. Quick check on markets now, because we are still seeing stocks in the red and in fact deepening their declines, being led by energy stocks. As we talked about earlier, the slump in oil today is definitely having an effect on those energy shares, although it's a broad-based decline. Last I checked, all of the groups in the S&P were down. Right now, the index is down 1.75%. Turning now to TikTok. It's risen through the ranks over the last few years, moving on from just catchy dances and short-form skits to a place where rising businesses garner traction. And we want to chat all things TikTok now. Bring in Kelsey Barbario, Yahoo Finance senior TikTok producer. She's making her Yahoo Finance Live debut in what is going to be a weekly segment where we talk about what's happening on TikTok. We are excited too. First of all, we wanted to sort of set the scene here and talk about why we are doing this, why we're going to be talking about this weekly. And one of the reasons that TikTok is increasingly important is because of how the interplay between TikTok and business, how trends are affecting businesses. So talk to us about that.
TikTok is having the most major effect on businesses, especially small businesses. You know, we're looking at makeup creators who can sell out a product in mere minutes. And so for some smaller businesses, that can be huge. That can be life-changing. And so we've seen stuff like that. We've seen, single moms who are able to, completely provide for their families because of what TikTok has been able to do for them. And it's just been really remarkable. And I feel like it's happened since the start of the pandemic. So that's been really neat too.
Absolutely. One of the major kind of movements in the competitive landscape, because it's all about the screen wars, right? And they're competing for screen time. And that also means you've got to cozy up to the creators and the influencers as well. We saw earlier this week, YouTube announced major changes to its YouTube partner program as well, seemingly to compete more with TikTok. And so, is this really going to result in people moving away from TikTok, creators moving away from TikTok to go over to YouTube Shorts?
I think that's their goal, obviously. I think they're giving away, 45% of their revenue or their ad revenue is meant to be going towards creators, which is huge. I've talked to creators who are in the creator fund for TikTok, and they are not seeing numbers even close to that. Like for a creator to make it on their own, what they're often finding is that they have to do some brand deals. Like they have to work with different businesses if they want to actually make a living off of TikTok. It's really not coming from the creator fund, despite what people may think. So I think that seeing something like YouTube Shorts do this, like that could be a big push. I know we're on YouTube Shorts for Yahoo Finance, so we're already in it, but I don't know if we're eligible to make any money, but maybe.
One of the other things that we're tracking on TikTok is not just what's going on with businesses, but also there's like, I track FinTwit, which is like the financial world on Twitter. And I know there's something like that it also occurs on TikTok. So what are we seeing trend-wise on TikTok this week? I guess in finance and just elsewhere.
Right, so we've got obviously some finance trends. Finance, I think, is inherently a little bit less trendy, so to speak, for TikTok. But they've got, have you seen the guy? He goes out and he's like, I'll give you $20 or I'll double it and give it to the next person. He goes out in like Washington Square Park in New York City. And people, it's like a social experiment to see who's going to take the money. So we've got stuff like that. That's kind of in the finance realm, I guess. But outside of that, we've got some exciting things. We've got a great dance, TikTok initially known for its dance videos. And so we've got Beyonce's new song, Cuff It. That one's been a very popular dance of the moment. I never dance on TikTok, that's not my vibe. But I appreciate the people who do. Outside of that, there's a trend where girls ask their boyfriend to give a word to describe them. So like you'd say, what color am I? You can do it for each other even. What color is Julie?
This is why I'm not on TikTok.
And then they'll be like, you are burnt sienna. And they're like, no.
Burnt sienna?
Yes, something so random. And so they do these crazy trends like that. And then there was the corn guy, the corn kid.
Yes.
Yeah, we know.
Yeah, we love him.
He's like, I think that trend has kind of died out at this point.
Yeah, but run him his check. Give him all the money.
I know. I think he's probably got his college set up. So honestly, for him, great.
Kelsey, this has been really insightful. I'm looking forward to even more of these conversations because there is so much of that correlation between what's really driving business and what's the most social parts of kind of commerce that's really emitting through TikTok as well. Appreciate you joining us this morning.
Thank you so much.
Chelsea.
Absolutely. Everyone, switching gears here, Netflix is looking to cut back costs in the comedy department. The streaming giant has begun changing its compensation plan for the specials, now licensing some for 2 years for $200,000, according to the Wall Street Journal. Yahoo Finance's Ali Canal joins us now. Okay, Ali, what do we know about this so far?
Well, Brad, this really is part of Netflix's larger goal to cut costs for the sake of profitability. So according to this Wall Street Journal report, this new licensing plan will shift some of that financial burden onto the comedians. So they will have to pay for their own production costs, which is something Netflix previously covered. In return, though, the comics will have more control over their work. So once this 2-year licensing period ends, they will regain full ownership of that content and can then shop that out to other outlets and platforms. We know comedy has been such a crucial element for Netflix. They've heavily invested in this space, hosting specials from Dave Chappelle, Bill Burr, Pete Davidson, just to name a few. Whitney Cummings was cited by the Journal as one of the comedians who will receive this 2-year licensing deal. And just to put this into further perspective, the streamer previously bought these comedy specials outright. So they would pay performers a lump sum. That lump sum could amount to as much as $1 million to help with some of those production costs, sometimes more, depending on the comic. So this is really just another option. Certainly more cost effective for Netflix. There's some pros and cons there for performers. So, we'll see. I think Netflix will want to buy some deals outright, especially for some of those more popular stand-up comedians. But the flexibility of choice, very important here as Netflix gets more aggressive with cutting costs. And also important to note that some of those other streamers that you're seeing on your screen, like Amazon, Apple TV Plus, they'll now have greater access to some of this talent. So perhaps it could shake up the landscape a bit there too.
All right, a lot to keep track of in the streaming space as of right now. Ali Canal, thanks for keeping tabs on it and breaking it all down for us. Coming up on the other side of this short break, everyone, Amazon, they're cracking down on its ebook return policy. Guess what? It's also correlated to those TikTokers we were talking about a moment ago. We've got more on this story on the other side. It's time for Cut for Time. 2 stories, 1 minute each. We start with this today. Got to talk about Amazon curbing its e-book return policy amid increasing pressures from the Authors Guild. Now, returns will now be limited to purchases where no more than 10% of the ebook has been read. Okay. Prior to this, customers could return a book up to 7 days in and get a refund, even if they've read the entire book.
Wait, you know what that's called?
This is the ebook
a
stuff.
library.
Well, yeah. So,
I don't understand.
I'm sorry, I'm leaning back because I'm just kind of floored by this. I mean, yeah, obviously they wouldn't let you return the ebook if you'd gotten through a certain amount of it.
Well, apparently they did.
What? I mean, there's so many other things that I like. I don't get to return a digital copy of something that I purchased if I've only gotten a certain amount into it.
Listen, I just want to say a word in favor of the library. Libraries also have ebooks, by the way.
What's your library?
If you don't want to pay anything for a book, go to the library.
And they're free.
Take it out.
Yeah.
It's a wonderful thing.
Free cards.
You might have to wait a little bit sometimes for the book. If you need that immediate hit,
yeah.
then it
bestsellers.
doesn't fill that. Yes, the bestsellers, you got to wait a little bit. But it's, you know what, patience is okay. Google CEO Sundar Pichai sending a clear signal to tighten belts at the tech company. In audio obtained by CNBC, Pichai said at an all hands, quote, "We shouldn't always equate fun with money." And what he was replying to, that's sort of taken a little bit out of context, but apparently there was a big discussion about the pullback that the company has done in expenses and various perks for employees, and people are not too happy about that. And he's saying, listen, this is a time of belt tightening. We have to realize what's going on in the wider world.
Oh, a lot of that was self-brought on, though, too, for retention mechanisms, for talent acquisition. They were trying to make it so that this is a place you want to come and spend more than 8 hours of your day at. You want to be here for 12 or 14 hours instead and have the ability to have your gym or all of your food experiences all in one. Ping pong, everything of the like. And so now that they're saying don't equate fun with money in essence here, it also does come with the realization that there's going to be talent out there that very much even thinks back to the GFC and is like, well, those things were still remaining intact at that time, at least.
These kids in their ping pong. Coming up, Akiko Fujita is going to speak with Evercore ISI's Mark Mahaney on his latest upgrade to Netflix. And this is as we see stocks way down today.
Welcome to Yahoo Finance Live, and happy Friday. It is 11 a.m. here in New York City. I'm Akiko Fujita. Let's do a quick check of the markets. It is not a pretty picture today. Take a look at that. The Dow down more than 460 points. The S&P 500 down 69, and the Nasdaq down 208. We are seeing energy, the biggest laggard on the day, but it is pretty much a bloodbath across the board here. A lot of this being led by bond yields soaring, particularly on the short end of the curve. The 2-year yield we saw shooting above 4.2%, hitting a new 15-year high. We've seen a pullback since, but take a look at the 10-year yield there, jumping to a level we haven't seen in 11 years there. So big moves in those yields there, leading to a broad-based sell-off here in the equity space. The recent moves prompting Goldman Sachs to cut its year-end target for the S&P 500 from 4,300 to 3,600. As part of its reasoning, Goldman Sachs says the interest rate path is now higher than it had originally forecast. For a closer look at all the market action today, we've got Yahoo Finance's Jared Blickery here with me. And Jared, you're also watching currencies.
Yes, and we're going to get to those in a second. The British pound racing towards parity with the US dollar, just as the euro did a month or two ago. But let's go to the Wi-Fi Interactive, where I'm charting the price action in the S&P 500. This is a 6-month chart, and we are racing towards those lows that we saw in June. So basically, we are looking at a situation where we're potentially heading to new yearly lows. And if you take a look at the Dow is already there. In fact, it has taken out those June lows. Let's see if I can get that up there. Looks like there's a little bit of lag, but that's good enough for government purposes. Also checking in on the US dollar. Now, this has been racing higher, and this has been placing a lot of stress on global currency markets. And I have a little graphic here I prepared writing this up today, and you can see at the very top there we have the Argentine peso. All right, now that has been devalued about 40% versus the US dollar, along with the Turkish lira. Turkish lira gets a lot of press because they are actually cutting rates, the opposite of just about every other central bank out there. But then you go down. So after the peso, after the lira, then it's the yen. This is a problem because the yen is a much bigger currency, the third or second most heavily traded currency in the world. I believe it's the third. Then the Swedish kroner, then the British pound. These are developed market currencies. Usually you do not see 15, 20, 25% moves in these currencies. You start getting these kinds of exacerbated moves with highly leveraged instruments, and then you see an unwind. Think of the flash crash. Think of some of that Lehman moment. In the global financial crisis, it was really about corporate debt and banks. And now we have the opposite situation where it's sovereign. So sovereign debt reared its ugly head later after the GFC, 2011, 2012. That's when we had the Euro crisis of confidence. That's when Mario Draghi, head of the ECB, had to say, we'll do anything that it takes. Is it going to come to that? You and I have been talking about possible more intervention by the BOJ. By the way, that hasn't done much. The yen has come back, and it's actually a little bit weaker today after that big strengthening move yesterday. So all of this looks to be a little bit too little, too late, and I think we're still going to see a lot of fallout.
Yeah, and with the yen, we're talking about a developed market currency. These are often EM currency swings that we see. Obviously, for EM, it means more debt, more expensive.
Yes.
A lot to follow there. Thanks so much for that, Jared. Well, let's continue the market conversation here with Scott Ladner. He is Horizon Investments Chief Investment Officer. Scott, it feels like it has been a step down every day of the week here. How much of what we're seeing today is a direct reaction to really concerns that the Fed is moving too aggressively too soon?
Hey, Akiko. Yeah, yes, quite a lot of it probably, and it's not. But it's, let's be honest, it's not just the Fed. Today, in reaction to Liz Truss's budget, UK rate markets are pricing in 100 basis points for November. So it's not just the Fed that's going really hyper aggressive right now. It's the BOE. It's basically it's everybody except for the central bank in China and Japan. Other than those, everybody's going really, really hyper aggressive. And the problem with that, as we all know, is that they're targeting a lagging indicator in CPI or PCE. And if they're targeting a lagging indicator and they're being very fast and aggressive with their rate hikes, the probability that they get it right and avoid some sort of recession or avoid some sort of hard landing is asymptotically low. It's just probably not going to happen. And so that this is what the markets are trying to grapple with right now. Not only falling multiples, which has been the story of most of this year, but now we're going to start hearing about earnings downgrades, and that's probably the next leg that we're experiencing right now.
So much of the jitters we're seeing today, driven by the big swings we're seeing in bond yields today. We mentioned that the shorter end of the curve spiking in a big way, the 10-year up as well. I mean, how much higher does it get? If we're talking about the 2-year at 4.2% right now, what are you looking at?
I think actually we're probably right about where we're going to get to on the 10-year. The market reaction today, we're seeing 2-year rates up a lot, and we're seeing obviously 10-year rates up in places like England, but in the U.S. 10-year rate's actually down a basis point or two right now. And so, I think that's the market saying, hey, listen, we think that we know that the Fed is going to go super aggressive, and so short end rates, that is the 2-year rate, can continue to go higher. But at some point, they're going to break it, and rate cuts will end up following. And what they're doing right now is not good for economic growth, and certainly downward pressure on inflation. And so, economic growth and inflation are the things that really drive the 10-year rates, whereas Fed policy really drives the 2-year rates. And so we're starting to see the market discern and sort of discriminate between what are the drivers of a 2-year rate versus a 10-year rate. And I think we're starting to see that the 10-year rate kind of peaking out around the 3 3/4 ish is probably about as high as we're going to get this cycle because the Fed is being so darn aggressive.
With that said, there's a lot of investors who are looking at the bond market saying, well, these yields don't look so bad when you look at the broader markets right now. Is this kind of a time you think to maybe move into bonds, or how are you looking at your portfolio and potentially shaking things up?
It's a little bit tough to call. Getting really aggressive moving into bonds right now. Frankly, it's hard to get aggressive moving into anything right now on a day like this. But it does probably make some sense to start nibbling at duration. But we wouldn't play in the belly of the curve. We wouldn't play in the short end of the curve necessarily. If you're going to start nibbling on duration, you probably want to go out about as far as you can stomach in terms of the curve, because that is where we're going to start seeing some real value. And we might be getting close to those points right now, but you're going to have to stomach some volatility over the next month or two. This is going to be probably a pretty whippy next 6 to 8 weeks.
So in terms of equities, where do you move then, Scott? Do you just hold cash? Is this kind of the safest way to go, given that so many have said that there could be significant downside going into year end?
Yeah, I mean, look, if you have some sort of de-risking instrument or some sort of process or algorithmic process to get you in and out of markets and kind of deal with risk in that way, that's one way to address it. If you're going to be more of a buy and hold kind of person and sort of move within equities, then probably moving more closer to the U.S. is going to continue to make sense. It's been sort of an old story. It's been a story all year long. You want to be as close to home as possible if you're a U.S. investor. That's still going to continue to be the case, and we're probably getting pretty darn close, Kiko, to the place where you're going to want to start moving away from value securities and more towards the growth securities. So those mega cap tech names and the really growthy names, not the profitless growth tech names, but the profitable tech names, that's going to be a safe haven in terms of where we can actually get to in equity markets, because growth is going to be scarce pretty soon. And that which is scarce is valuable. And we know that those mega cap tech names really have quite a lot of growth. And so they will start picking up some value and some allocations as we move into the back half of this year.
Yeah, some good takeaways there. There's a lot of investors reassess their portfolio today. Scott Ladner, Horizon Investments Chief Investment Officer. Appreciate your time today. When our trending ticker today, the prospects of higher shipping rates and cost cutting pushing shares of FedEx lower. The stock is down nearly 3% there, hitting a new 52-week low today. The company announced it's raising rates by nearly 7% for its express ground and home delivery services. It's part of a move to slash $4 billion from annual costs. The news comes 1 week after the shipping giant warned its fiscal first quarter results were being weighed down by weak global demand, sending stocks tumbling. Despite those concerns, the company is maintaining its forecast, projecting annual revenue growth of 4 to 6%. Coming up next, is now the time to buy Netflix. Our next guest looks past the streaming giant's recent struggles and makes the bull case for the company. That's coming up on the other side. Welcome back to Yahoo Finance Live. We've got a new bull on Netflix. Evercore ISI citing the upcoming ad-supported tier and password-sharing crackdown as reducing user churn. The move comes as Netflix struggles to retain dominance in an increasingly competitive streaming space. Let's bring in Mark Mahaney, Evercore ISI Senior Managing Director and Head of Internet Research. Mark, it's good to talk to you today. You know, early on this year, you mentioned, you were kind of critical of Netflix, saying that they have been slow to pivot in this changing landscape. But it sounds like you see real levers here with this ad-supported tier, a crackdown on password sharing. What are you seeing?
That's right, Kiko. I think that's the right setup. And I also, fully agree with what your prior guest, Scott Wagner, said about you need safety. Megacap can maybe help you. I'm looking at names that have been really beaten down, and Netflix is probably at the top of that list, down 70% at one point year to date. Now, it's had a 40% rally recently, and it's because of this ad-supported business that they're rolling out. So, look, you've got Netflix now that's finally beaten down to a place where you could buy it at a PE multiple, like 16, 17 times earnings, first time in a company's history. And then you've got a new revenue stream. One of the big problems that Netflix has created for itself is that they've raised prices consistently over time. They're the leading streaming service globally, but they've kind of painted themselves into this kind of premium price, premium product corner. Offering a lower price ad-supported solution gets them out of that corner. I think expectations are still super low. And so I think this is just a great upside opportunity for the company and for the stock. It's the most identifiable catalyst that I see out in consumer tech today.
So let's walk through your thesis a bit. You said 20% of churn users are likely to return to Netflix with this cheaper ad-supported model. That means 10 million in incremental subscriber net adds, $1 to $2 billion in incremental revenue. How much of that churn, you think, or return back to Netflix comes from previous subscribers? How much of it is about bringing in new subscribers on board for those who may have said before, this is a little too much for me?
Well, Kiko, it's almost impossible to know that. And in all honesty, none of us know what the real price point is going to be for Netflix. We don't know how they're going to market it. So there's a lot of what ifs in the analysis. But what was interesting to me is the survey work I've done for 12 years, we have seen since the beginning of 2018 rising price sensitivity amongst Netflix customers. And we've seen declining satisfaction, at least in their most mature markets like the US. And then when we looked at what the other streaming companies are doing, they're able to generate $5 to $10 in ad revenue per user. And so the light bulb that went off in our heads was, wait a second, Netflix could lower its pricing, its subscription pricing by $2 to $3 and still generate more revenue per user because they can get $5 plus in ad revenue per sub. So we've got something that kind of addresses the price sensitivity and is positive for unit economics. I don't think that was captured in the company's valuation. I still don't think it is. And I don't think it's captured in street estimates. That was kind of the upside call for us on Netflix.
So, Mark, price sensitivity is one thing, and you point to the declining satisfaction among those users, but what about the actual quality of the content? I mean, this is a company that spends about, $17 billion in content. Some would argue that they have really gone for quantity over quality. That's at the core of the churn.
That's possible. Now, that's why we do the survey work. So, Kiko, we've surveyed 2,000 people in the U.S. and in other countries, and we've done this for 12 years. And we ask people, why did you leave? Why would you leave? What would get you to come back? And what is, for the first time, just in the last year or two, shown up as the number one factor is price sensitivity. And then we do also ask people, to rank all of the streaming services in terms of the perceived quality of content. I mean, that's really a judgment call for all of us, where really is the best content in terms of streaming. But, the objective answer we try to get at through surveys clearly shows that Netflix is perceived as having content as good or better than anybody else. And I'm not terribly surprised by that. They've been longer into streaming than anybody else. Now, there's some wonderful other streaming companies like HBO and Disney Plus, but Netflix is spending probably about the industry high in terms of $17 billion in cash spend per year. And every once in a while, it produces these mega hits, Bird Box, Stranger Things, Squid Games. And I think what's happened to the stock is people kind of forgot about that. There's probably another Squid Games out there. The odds are that there is. I sometimes think about it as 17 billion shots on goal. Something's likely to go through for Netflix. Yeah, so that's kind of part of the call.
I mean, that's a fair point. I don't think anybody would have predicted the big hit that Squid Game would become. You were on with us earlier this year saying Netflix is no longer a premium growth story. Does that case change you think, as a result of the potential catalyst you see coming from the ad-supported tier as well as the crackdown on password sharing? Are we still talking about below 20% plus?
Yeah, Kiko, thanks for pointing that out. No, I don't think that Netflix gets back to premium growth. I don't think it gets back to 20%. As a stock picker or as a potential stockholder, what you should think about is if they were, this stock is going dramatically higher. So why? Because the street right now is looking for 8, 9, 10% revenue growth. I think that ad-supported, particularly ad-supported offering, but also some password sharing crackdown, they have to be really careful about that. They have to do that. You have to do that right. But if they get those out, that could bring growth back up to kind of 15%. So this isn't the go-go days for Netflix. They had them. It was the best performing stock of the S&P 500 last decade. I doubt it will be this decade. They won't be able to generate that kind of growth that they did so consistently over the years. But this stock can still nicely outperform from here. You want these dislocated stocks that have been beaten down, that have got reasonable valuations, and are starting to generate real interesting free cash flow stories. That's the setup on Netflix, a stock that's been hated, but starting to turn. And I think this turn can go on for quite some time.
Finally, Mark, when you look at the broader streaming space, Amazon's seen a lot of success in the first 2 weeks of Thursday Night Football. Obviously, that has been a big catalyst to get more on board with Prime. You look at Apple moving aggressively on sports, whether it's MLB or MLS. You think Netflix can continue to stay on the sidelines when it comes to sports streaming?
It's possible that this gives them the entree into sports. I've talked with the management team about this numerous times over the years. The one pushback they've always had is, we're an on-demand streaming service. Like, you come on when you want to watch something, and it's on your schedule, your dime, your schedule. And sports isn't built that way. Sports is on the team's schedule. So it's kind of a different value proposition. It's also extremely expensive. I think Netflix doesn't need to get into sports. I may be wrong on that. And, I've seen Netflix pivot. They refused to get into advertising until they finally did earlier this year. So they've refused to get into sports. It's possible that they change that, going forwards. But I don't think we'll see that kind of pivot from them in the next couple of years. I think they're all in on advertising, and they're going to run this and see how well that goes.
Yeah, they've talked about sports adjacent content, not necessarily live sports, but we'll see if that shift happens. Mark, it's always good to have you on the show. Mark Mahaney, Evercore ISI Senior Managing Director and Head of Internet Research. Well, taking a look at the crypto space today, moving this morning as markets digest the Fed's hawkish moves. Take a look at Bitcoin, still below that $19,000 handle. Ethereum up about 1.5% right now. Let's bring in Yahoo Finance's David Hollerith in the flesh with us in studio today. And David, we were talking about this off camera, the correlations that we've seen with crypto moving in tandem with the equity space. So much of this is about what's happening in the macro space, but you said that you're starting to see a bit of a divergence.
Yeah, so yesterday, leading up to the FOMC, all the analysts I'd spoken with pretty much made it clear that crypto was not going to fare well following the decision, and that it's actually held up better than expected. And that break in correlation that we saw yesterday is sort of returning now. So sometimes cryptocurrencies, because they trade 24/7, will just lead stocks. We're still kind of watching. I've heard other people say that it might be shorts having to cover. So we'll have to do a wait and see here. But the expectation was that cryptocurrencies were going to fall a lot more following that Fed decision. So it's interesting, and it says a lot about sort of the investors in the sector right now.
Well, I thought it was interesting. You're at a crypto conference here in New York earlier this week, and so many people are watching the Fed decision. Not necessarily something we would have said, a few years ago. But the other thing that made headlines there were some comments coming from Ripple's Brad Garlinghouse as he faces this lawsuit from the SEC. What's the very latest on that?
Sure, yeah. So the Ripple SEC lawsuit has caught a lot of attention since Saturday. What happened was the SEC sort of released their motion, and then Ripple sort of replied in a rushed fashion between Saturday and Sunday to sort of issue their statements too. And essentially, both sides of the case are asking for the judge to come up with a decision to see whether or not it has to be brought into court. And this is, of course, about whether or not XRP, the cryptocurrency, is considered a security. The SEC thinks it is, and Ripple Labs says it's not. And that comes down to whether or not it's an investment contract, which I won't go into too much detail there. But Ripple is up 45% right now, and I won't draw a conclusion there, but I think investors are pretty happy. Garlinghouse has come out as sort of saying that, this lawsuit is dragged on it's been going on for 2 years. But it's interesting outside of the Ripple company because for the overall crypto community, like a lot of people are really seriously looking at this lawsuit as a way that might actually bring clarity regardless of who it rules in favor for.
Not just for Ripple, but for the broader space.
Yeah. And so everyone's watching that. But the truth is, for that to really happen, it needs to go to court. And Ripple is sort of like saying that they don't think it does. So we'll see what happens. But if it does go to court, it'll be dragged out longer, probably will not be settled by the end of the year. But it will be a major decision about whether or not certain cryptocurrencies are deemed securities.
So more uncertainty in at least the short term.
Yeah, through the end of the year. But we're going to see more motions in the case, and we'll see how it's progressing in terms of whether or not Ripple has more evidence on their side or the SEC, what's going on there. And an interesting thing is that a third party has stepped in recently, a blockchain lobbying firm, the Chamber of Digital Commerce, and they're basically coming in as a third party. They've been approved by the judge, and that should make things interesting.
Okay, it'll make your next few months interesting. David Hollerith, appreciate you staying on top of the story. Good to have you in studio again.
Yeah, it's great to be here.
Coming up, inflation isn't taking a bite out of Costco's $1.50 hot dog and soda combo. We're going to break down the company's latest earnings report after this short break. Well, shares of Costco moving lower this morning, well down more than 2.5% here after the wholesale retailer reported earnings that beat expectations yesterday after the bell. But Wall Street was left disappointed in after-hours trading. Brooke DePalma is here with the details. Brooke, let's start with the membership fees, because the expectation has been for a while that it is going to go up. And yet this is a company that still has a lot of loyalty baked in.
That's right. A lot of loyalty here. Renewal rate about 90%. So customers are continuing to return year over year, willing to pay that cost. Of course, yesterday on the call, Richard Galanti, Costco CFO, saying, quote, there are no specific plans regarding a fee increase at this time. We're pleased with our growth in both top line sales and membership households over the last several quarters. And member loyalty is reflected in increasing member renewal rates. We'll let you know when something is about to happen. Of course, let's take a step back and take a look at how much exactly it costs. So for a basic membership at Costco, it's about $60. Now for their gold membership, the executive membership runs about $120. Of course, that is a little more expensive than one of its top competitors, Sam's Club, that is owned by Walmart. They recently announced an annual increase set to take effect October 17th. That's about $50 for club members, $110 for plus members. That was about a $5 increase and a $10 increase. But of course, that was the chain's first in 9 years for the basic membership and the first time since 1999 for Sam's Club. But to give more context here on when those Costco loyal customers might expect to increase, the CFO said that typically they do every 5 years and 7 months. So the last increase was June 2017. That would bring us to January 2023. They said no plans as of yet, but it's not a matter of if it happened, in a matter of when it'll happen. Of course, Wall Street reacting to that earnings report yesterday after the bell, but Goldman this morning reiterating a buy, saying that it continues to have increased confidence in the stock as the big box retailer's strong earnings report yesterday, and they have confidence in those customers to continue to return.
So Costco is always a good gauge of where inflation is right now, but also how customers are responding. The question they get over and over on every call is, what about that hot dog and soda combo? $1.50 is still an incredible deal. Are those prices going to go up now?
Well, Akiko, those prices are not going to go up as of now. Now, this has gotten a lot of attention in this past year. It even was brought back up on the call last night. In Q3, someone tweeted that they were adding an extra $1 because of inflation. And then quickly they shut down those rumors in the third quarter earnings call. This quarter, they also addressed that. They said that the fresh foods business, they saw about 40% sales, 20+% increase each year. They said that it's an improvement on the bottom line. They have no plans to make that price higher for the hot dog and soda combo, but they have increased a few other items in that fresh foods court, you could say, but no plans to increase that price as of now. Of course, it's a staple at Costco, and so customers will certainly respond if they do.
A big sigh of relief. $1.50. I think that's cheaper than
a 20-ounce soda,
cheaper than
and
pizza.
a hot dog, cheaper than pizza, cheaper than just about anything right now.
All right. Glad to hear they're keeping it for now. Thanks for that, Brooke. It's been a rough year for home buyers with mortgage rates now above 6% and a massive affordability crisis now taking hold. Luxury home buyers have largely been exempt from that conversation around struggling real estate, but a new report by Redfin shows rising mortgage rates are finally catching up to them. Yahoo Finance's Rhonda Lee is here with that latest report. And Rhonda, what does that tell you about where the housing market is when we say even luxury home buyers are thinking twice?
So the economists have said that this has been the worst housing affordability crisis this year. First-time home buyers, entry-level home buyers have been pushed out of market since the beginning with low-level inventory and rising rates. Earlier in the year, high-end home buyers had an edge. They were using their all-cash offers to win bidding wars. Mortgage rates have surged above 6%, causing the luxury home sales to plunge by 28%. So what's happening is, if misery loves company, then regular home buyers in the market can rejoice in the fact that knowing that even high-end home buyers are now in the same boat of, maybe this isn't a good time for me to buy.
So where does that leave buyers right now? I mean, obviously their buying power has been decreasing because those rates have been going up. Prices may be coming down on some end, but that's being padded to the actual monthly mortgage they're going to have to pay now.
So here's the deal. Most analysts say that for every 1% increase in the rates, buyers are losing about 50 grand in buying power. So for your luxury home high-end buyer, if in the beginning of the year their budget was 1.5 million, now their budget is 800,000. So for everyone's feeling a crunch now. So that in particularly now you have with the inflation, you have the fluctuation with the stock markets. They're saying that some high-end buyers are looking elsewhere for their investments instead of getting that second home or buying at these rates.
Okay, more pain to come. Rhonda Lee, thanks so much for that. Coming up on the other side, the new Apple AirPods, all the rage, but are they worth the new $250 price tag? We're going to break down the company's slew of new products launching today on the other side. Apple's new iPhone 14 is already facing some bugs. Users reported the camera on the 14 Pro shakes when using certain apps. This is more new hardware, including the new generation of AirPods and Apple Watches are being rolled out. For more on what's ahead for Apple during this release period, let's bring in Francisco Geronimo. He is the Vice President of Data Analytics at IDC Europe. Good to talk to you today. Another big day for Apple. Let's start with the iPhone 14, though. What does this upgrade cycle look like when you consider the product itself, but also some of the headwinds consumers are facing, maybe thinking twice about spending up to upgrade on their device?
Hi, indeed, that's a very interesting question, because the reality is that the majority of clients are really concerned with the cost of living, with inflation, with many other economic concerns. But the reality is that the new iPhone is not targeting those who upgraded last year. It's targeting those who upgraded 3, 4, 5 years ago. And we also know that the majority of those clients are trading in their previous phones, so getting a very interesting discount for the new one. And they are buying the phones on a financing scheme where they pay a monthly installments rather than paying a quite high price tag when they buy the new one. So at the end of the day, yes, there's some concerns, but the majority of customers and consumers are looking to upgrade to something that is performing much better than the phone they have, which they bought 4 or 5 years ago.
So to your point, I mean, there are enough cost structures out there that allow users to get this device in a more affordable way. But in terms of the features themselves, is it worth the upgrade?
Well, there's always some criticism about when a new phone comes out, how much does it look to the previous one and whether the features are worth it or not. But what we also know is that the majority of us rely more and more on smartphones. So having good cameras, having good displays, having good batteries, good storage on the phones, it's critical because this is not just about making some phone calls or playing some games with some apps. It's about our daily lives and our work. And that's why most consumers around the world are moving to better devices, higher price points, because they know that they need to pay more for a device that really helps on their lives rather than just having a device that will crash over and over. And that's what we are seeing is most consumers upgrading for better and better devices, not just from Apple, but even from other vendors. Samsung facing the same kind of opportunities, growing their sales towards higher price points, and even the Chinese players also pushing towards price points, because what consumers really want is not just a smartphone, is a phone that really helps on their lives.
Another device that's getting very strong reviews, this is the AirPods Pro that's out today. In terms of what this means for Apple, I mean, we often have been so focused on some of their other devices like the iPhone, but this has really been a big hit for the company. When you look to the whole pie that Apple has, how significant a revenue source do you think these AirPods can be moving forward?
Yeah, that's indeed a huge opportunity for Apple. Just to give you a specific number, Apple has sold over 328 million AirPods since launch in 2017. This means $63 billion in revenues. This is a massive opportunity for Apple, and we are just touching the surface, because at the end, what we are also seeing is that the majority of users don't yet have a wireless headset, and we all know how convenient it is when we moved from a wired headset to a wireless headset. And that's the transition that most consumers are doing. And that's the opportunity that Apple has ahead in the coming years, because we see on the wearable space, this is being the biggest category and the one that is growing the fastest because of this transition to wireless devices for the convenience and how easy it is to have something on your ears rather than having wires around. So this is definitely a massive opportunity for Apple. And we are seeing, and they are leading this space with a significant market share and a significant business. 63 billion is not a small business with one category only.
Francisco Geronimo, IDC Europe Vice President of Data Analytics. Appreciate your time today.
Thank you.
Well, it's time now to take a quick detour or look at the hidden headlines you should know. And this one is literally out of this world. NASA has released new images of Neptune from the James Webb Space Telescope, showing off some of the planet's rings. NASA said the telescope's advanced technology captured the clearest view of Neptune's rings in over 30 years, since NASA's Voyager 2 captured the rings during a flyby in 1989. The Webb telescope has been releasing pictures of deep space since July, offering people a better look at the galaxies far, far away. Well, coming up next, the future of work. PagerDuty is partnering up with Salesforce in a way that the company says will make work, in their words, unstructured and unpredictable. We're going to hear from PagerDuty's CEO on the other side. Welcome back to Yahoo Finance Live. We are continuing to see a broad-based sell-off across the board here on this Friday. Now at session lows with the Dow down more than 500 points. We're talking about 1.7% there. The S&P 500 down nearly 2%. And the Nasdaq down roughly 2% as well. So much of this stemming from what we heard from the Fed on Wednesday and concerns about the central bank moving too aggressively. What that means for the broader economy. Should point out sectors we're watching today. It is red across the board, but energy really taking the brunt of the hit. And let's take a look at where oil is trading right now. When you take a look at oil futures, well, energy sector right now down about 6.5%, but oil futures down there you go, 5% or more than 5% when we're talking about WTI. So certainly a pretty ugly day across the board to round out what has been a very choppy week. Well, the future of work is changing as macro trends drive the digital acceleration. Companies are looking to automate work and collaborate in new ways, including from the cloud. Standing to gain from these trends is PagerDuty. Yahoo Finance's Brian Sazzi sat down with its CEO, Jennifer Tejada, at the Dreamforce conference in San Francisco, where they discussed digital trends and the company's take.
Salesforce has been a terrific partner to PagerDuty for the last several years. I think this is my 7th or 8th Dreamforce, but this year it's really a family reunion, and we hear customers talking about innovation, automation, leaning into the future they want to build for work, which is digital. And we're essential infrastructure that sits at the core of the always-on, sort of on-demand world now. So it's a great opportunity for us to talk about our partnership with Salesforce, where they're using us with Service Cloud, our customer service ops solution, but also a great opportunity for us to reconnect with customers we just haven't seen in a really long time.
Absolutely. So I love this panel that you were on, the automation revolution, building the new future of work. Take us through that.
So I'm a huge believer in efficiency. You could call me an efficiency geek, actually. And we believe in building automation for our users in service of freeing up people, giving them the freedom to do the purposeful, intentional work that they signed up to do when they took their jobs. And so PagerDuty uses APIs and artificial intelligence to detect work through Signal's 700 integrations in our platform and intelligently orchestrate that work to the right people in the right moment to ensure that our customers can deliver on their digital promise to their customers. And we've really found that employees are embracing automation if it reduces the toil, if it takes on the mundane work that they don't want to spend time on.
Nobody wants to push paper anymore, Jennifer.
Nobody wants to do mundane stuff.
Take us through, how does this change? How does this change the business now that this whole workforce globally, many workforces are distributed globally? They're not in a central hub. There's no more office.
Well, the developers, led the way on this. So the developer community has been distributed by design for many, many years. And as with most things, they influence the way we work, and they often drag us towards exciting innovation and change. And so PagerDuty's platform was built for distributed workers and for this concept that we call interrupt work. This idea that the way we work is shifting from being planned and structured and super predictable to actually being unstructured, unpredictable, and often time sensitive and mission critical. And there aren't platforms out there that exist from a decade ago that enable you to do this kind of work. So machine learning, AI, really helps distributed teams not only detect the work, but prioritize it, understand what's the most important thing they should be working on, and in a distributed organization, orchestrate that work to the people who have the skills, the talent, the ownership that can help them get it done.
This has been this is a very interesting time for the economy, U.S., overseas. You had a good quarter a couple weeks ago. I think it surprised a lot of folks in the street positively. What are you seeing in the business, and were you surprised?
No, I wasn't surprised. We've been consistently delivering great results. Revenue grew 34%. Net dollar retention was 124%, I think above 120 for the 7th quarter. And really that's driven by the same macro tailwinds we've been talking about for several years, which are digital acceleration. The market and the world has moved towards digital, and we support all the services and the infrastructure that drives those outcomes. Cloud adoption continues. continues at a very strong pace, and DevOps transformation has become mainstream. We're seeing potentially a fourth tailwind, which is there's still a talent shortage for technical workers, for developers. And every customer I've talked to, as I've been traveling the world over the last several weeks and months, is telling me they're trying to figure out how to improve the productivity of their technical teams because they need to do more with the same number of people they had last year. We see some companies tightening their headcount growth and really wanting to make sure that their most talented technical workers are delivering the most productivity they possibly can.
When you talk to customers, and even when you talk to your own employees inside the company, how nervous are they about rising interest rates? And does that change how you plan and operate the business as you look into next year?
Well, look, we have been playing the long game for some time and been very focused on our path to profitability. We've committed to the market that we'll be profitable by Q4 this year and for the full fiscal year next year. And that's been a multi-year plan to demonstrate economies of scale as we grow. And I think, people hate change, people hate uncertainty. So I try and keep our employees focused on this long-term legacy that we're building to be the operations cloud for our customers, to really help them automate and manage the work that matters to ensure that customer experience is perfect. And we've really seen that manifest itself here at Dreamforce, talking about our application for customer service ops, which integrates into Service Cloud and helps customer service teams bridge the gap between hearing about issues from their customers and being able to work automatically in collaboration with the developers and the product teams that actually build those services and can fix those, those applications, those web apps, those mobile apps that you're used to using when they're not working as well as they're supposed to.
That was Yahoo Finance's Brian Sazzi in San Francisco with PagerDuty CEO Jennifer Tejada. Well, it's time now for our chart of the day. And today we are locking in on New York Yankees superstar Aaron Judge in his attempt to break the American League's single season home run record. You don't have to be a Yankee fan to be following this, by the way. The chase for that record leading to a big rise in average ticket prices for a Yankee game this weekend. According to SeatGeek, ticket prices to sit in left field in hopes of maybe catching the history-breaking home run ball have nearly tripled in the past few days since Judge hit his 60th home run of the season. He now needs just 2 more to break the record. And a lot of people checking their schedules to see if they can be at Yankee Stadium when that happens. Well, coming up on the other side, move over to Pepsi. The NFL has a new halftime show sponsor as Pepsi ends its decade-long run as the namesake of the event. We'll have details on the other side. Well, Pepsi's run as a sponsor of the Super Bowl halftime show has officially come to an end after a decade. The NFL now selecting Apple Music in a multi-year partnership to sponsor the halftime show. For more on what this all means for Apple, let's bring in Yahoo Finance's Josh Schaefer. And Josh, we're just saying, I mean, Apple just has so much money, right? Why not just go out and sponsor the Super Bowl halftime show?
They could do anything they want in terms of sponsorships, right? But I think this is an interesting play for Apple for a couple reasons. And one of the main reasons is I think it's probably one of the best Super Bowl advertisements you can get, if not the best. Of course, probably expensive. The estimates beforehand were about $50 million annually is what they thought the NFL was going to get for the halftime sponsorship. But when you look at what Pepsi got last year and sort of where they came out in post-ad metrics, I remember we did a story back right after the Super Bowl with Elevate Sports Ventures and Hive looking at some analysis. Pepsi was mentioned 11 times on the broadcast.
Right. Every time you say the halftime show, you have to say the Pepsi halftime show.
Right. And so Pepsi 11 times, that was more than double the next brand. The next brand was Toyota with 6. SoFi Stadium, where it was held, was only mentioned 5 times. And then you look at how often was Pepsi on screen. Pepsi was 4th in terms of brands on screen with nearly 4 minutes on screen because they keep showing the halftime show and they keep promoting it. So you keep popping up. 120 million people watched the Super Bowl last year and watched that halftime show. And it's kind of, from the experts we talked to, it's a little bit ingratiated into your head, right? Ingrained into your head that way, where, oh, okay, it's not as obvious as an ad, and they think consumers normally kind of respond better to that. And then, of course, there's the other side of this, Akiko, with Apple getting into sports, right? And we're kind of seeing more of that too.
So Apple getting to sports, but this is an interesting one for me because it's Apple Music, right? If you think, well, okay, if Apple's going to get mentioned 11 times, is that really that big of a deal? But Apple Music, still kind of lagging behind competitors like Spotify. When you've got music at the core of the halftime show, that's a good way to integrate the product.
Right, integrate the products, probably have some special releases on Apple Music, right, that come out that I don't know who the halftime show is yet this year. I don't think that's been announced, but whoever that is, you get specials that then go on to Apple Music. And another thing too we've heard for brands that kind of connect with the NFL is people trust that more because people trust the NFL. So if you can get Apple Music presenting something instead of Spotify, people are like, oh, the NFL likes Apple Music. Maybe I should like Apple Music too. And I think that's sort of how they see this from an advertising perspective.
Yeah, I know they haven't disclosed the full terms of this, but I'd be curious to see what the return is like, right? Because how do you really measure that? If you're a company like Pepsi over the last 10 years, having those mentions, having all that advertising.
I think it's an ecosystem play too for Apple. Because I talked to Dan Ives this morning over at Wedbush Securities, and I asked him, why are they doing this? Like, what's the play here? And he said, it's the drum roll for Sunday Ticket. He's been long on the fact that they already have Sunday Ticket and it's gonna come, but he's like, this is the sign that they're beating Amazon for that. And so then you have NFL Sunday Ticket, you're in the advertising, hopefully someone's watching it on an iPhone, all of a sudden the entire NFL experience is Apple or Amazon oriented, which would be pretty crazy.
It all connects. Josh, thanks so much for bringing us that story. Let's do a final check of the markets before we let you go. We have seen a broad-based sell-off across the board here, with the Dow now down more than nearly 2% here, really across all 3 majors. The S&P 500 down about 76 points, the Nasdaq down 222. We're going to continue to follow the market sell-off across Yahoo Finance, but for now, that does it for me in this hour. Keep it right here.
Kicking off their holiday percent more on holiday purchases compared to last year. That's according to a new survey out of Stifel on consumer spending. Joining us now to add some insight is Stifel's Managing Director for the Consumer and Retail Sector. That is Mark Astrachan. Good to see you, Mark. Thanks for being here. I want to start with some of these hiring plans before we really dig into the meat of the survey, which was very interesting. Target saying it's going to hire 100,000 folks. Walmart only 40,000. I mean, what can we, if anything, read into some of these plans?
Yeah, thanks for having me first off. I think it's probably a little bit hard to read into the plans specifically because you just don't know necessarily what the hiring levels are behind those. But yeah, I think generally speaking, it's encouraging to see at least that they're looking to hire folks and that they're actually finding folks to actually hire, because if you recall over the last year or so, it's been just a lot harder to find people to come into those jobs given where unemployment is. And so I think they're basically trying to get what they can. I think probably the fact that numbers aren't exceedingly above where they've been in the last couple of years would suggest that they're probably in a pretty good spot at this point to be able to service the customer adequately. And just as an aside, but I think interesting too, remember a lot of the folks that they're hiring are not just doing kind of front of store, but they're also doing things behind the scenes to fulfill digital orders as well, like buy online, pickup in store, buy online, pickup in parking lot as an example. So you do need more folks than you did 5 years ago, but I think they're probably in a decent spot at this point.
What does that tell you, though, about some of their margin compression, perhaps what they're expecting based on the hiring levels that they have set forth and because they are so dramatically different from last year?
Well, I guess it's going to depend. Walmart's up 40,000, Target up 100,000, but again, kind of similar to prior year and Walmart below. So I guess on a net basis, that's probably better if you have fewer people versus the prior year. But this year, the margins are not just hiring of people. Of course, there's all the inflation overlying everything else that's going on. And so all these companies have just seen a massive pressure on cost. On top of that, the slowing of general merchandise, discretionary, however you want to put it, category sales in the fiscal second quarter, kind of May, June timeframe, that obviously weighed on margins there. So the expectation would be that things get better from a margin standpoint relative to where the lows were earlier in the year. So not necessarily a comment on the year on year in the holiday period, but certainly better than where we were in the July quarter, for example.
Yeah, and speaking of which as well, when we look at your spending survey, people in terms of their spending intentions, net discretionary spending intentions you guys found were up 10% in mid-September. That compares to about a 6% increase since June. And I guess you can account for some of that with the lower gasoline prices. I mean, how do you tease out these spending intentions and account for higher prices as a part of that? In other words, if you ask someone how much more do you expect to spend, how much of their answer depends on how much more they think they're going to have to spend on the same stuff.
Yeah, it's a good question. It's not really one of those things that we get into a lot of specifics in asking folks what they think about the inflationary aspect of what they're spending relative to what they're actually spending. But inherent in that, obviously, is at least some level of inflationary pressure that goes into it. But I think really the high level just suggests that the consumer, regardless of what we're seeing and debating from a market and macro standpoint, that the consumer is actually feeling a little bit more robust or less influenced by kind of some of those higher level items. And to your point, I think the gas prices, it's really hard to kind of overstate what the impact was on higher prices in early June and obviously lower prices on a relative basis from there. And we asked the question on just how much impact you're seeing from gas prices on spending. And it's still inflated relative to historical levels. 60% of our respondents say that they're expecting some impact from their spending on gas prices, but that's down 10 points from where we were in June. And obviously gas prices are down materially since June, still up, I don't know, I think 15% or so year on year. So I think that's kind of what you're seeing here in terms of the overall spending. The lower gas prices really is helping the consumer kind of thinking about that. And the holiday spending kind of coupled with asking on back to school spending that we started in I think late July or early August show that you're actually seeing two improving spending intentions on just back to school, but also on a holiday, that those levels in terms of where our back to school spending ended, which was down a couple points versus a year ago, is much better than down high single digits where we were in early August when we started asking that question. So I think you're kind of seeing the consumer spending appetite increase as gas prices in particular come down, and then they're just dealing with inflation as they can, but there's not a lot you can do.
What type of divide in that spending intention are you seeing among different income brackets, perhaps, and especially as we've seen a relative resiliency in some of the higher income spenders versus the rest of the market, the rest of the economy, and consumers that are trying to exactly determine where they can still spend on discretionary things versus kind of pulling it back in entirety? And is that starting to trickle into the higher income brackets as well?
Yeah, it's actually really, really fascinating. So we take the income levels and kind of look at those questions that we ask, a lot of the questions, but the very high level of spending, the high level of back to school and holiday. And what's really fascinating is it's been ongoing for a while that those earning less than $75,000 per year have, in absolute terms, said they're going to spend less on a year-on-year basis. And that got worse as we went through spring and early summer, peaked or troughed in June from higher gas prices and has gotten better. So if you take a look at the most recent survey, those consumers, again, those earning less than $75,000 per year, say they're going to spend 17% less versus year ago versus the overall 10% number that you said. So it obviously tells you how significantly up the spending intentions are for those earning more than that. And if you take a look at the back to school and holiday, the same dynamics play out where those earning less than $75,000 are going to spend less. But interestingly, holiday spending intentions were actually higher relative to overall spending in each income level, including those lower income consumers. So suggesting that the lower income consumers are going to spend less year on year, but they're actually spending less than just the overall, or I should say they're spending more than the overall discretionary spending. So they're still planning on spending more just in absolute terms on holidays. So somewhat encouraging there. And I'll just add too that if you look at that under 75,000 level, it's, as I said, gotten better since June. I think that's probably the important takeaway here, that lower income consumer is feeling a little less pressure right now because of what the gas prices are.
Where are all these people going to spend their money, Mark? Just real quickly, what's your pick going into the holiday season?
I'm not sure I have one, but I think maybe broader strokes here, kind of punting the question. Discretionary spending's obviously been pretty weak in the first part of this year, and so I think you're going to see that those categories that were most weak probably come back a little bit more as we head into holiday.
Stifel Managing Director Mark Astrakhan joining us here today. Thanks so much for this survey, the insights, and breaking this down for us. Appreciate it.
Let's talk more about the Fed here with RBC Capital Markets Head of Rate Strategy, Blake Gwynn. He's joining us live in the studio. We heard about the enthusiasm, the tech spending that's continuing on out there on the part of Salesforce. Brad Smith was very excited about your FOMC recap title their note title this morning, all about that pace. He was enjoying the Meghan Trainor reference, all about that pace from the Fed. And indeed, it is all about the pace, and that the pace is going to keep right on going. For how long and at what cadence can we expect the Fed to keep raising rates?
Yeah, I mean, I still remember back in June when 75 basis point hikes were still supposed to be something that was very abnormal. But here we are, X number of hikes later. And I think what the Fed did yesterday via the dots that they released, the forecast, basically told us that this 75 basis point pace of hikes is going to continue at least until November, which I think is notable because we, as recently as kind of pre-CPI report, we were expecting that turnaround to really happen at this meeting, but indeed another 75 and continuing into November. So that's really where we're looking for the downshift. But obviously, I think there's risk to the upside for that as well if we get continue to see very high CPI prints.
What parts of the market do you believe would be most heavily impacted by this new target that's set forth as well? As we were looking at some of the declines earlier, especially in the tech sector, as we've been continuing to track that too.
Yeah, I think on the equity side, it's really mostly the the heavy interest rate sensitive sectors, as you mentioned, tech sector. But as a rate strategist, I really think about the different parts of the yield curve, and there I think the front end is really what was susceptible to that dot plot yesterday, and that's really what we saw after the meeting, a very clear-cut response to this higher expected path of rates. The front end of the yield curve went considerably higher, but at the back end we actually saw, I think, some of that hard landing concerns and recession risk pricing itself into the back end with this kind of risk averse move, pulling those yields further down. So for me, it's really about the front end pricing in that higher path.
With this outlook for rates, is there any outlook for rates on the part of the Fed? Is there any ceiling on what we're going to see from the short end of the curve, for example?
Yeah, I mean, I think at least, and again, back to the pace and the title you mentioned, I do think they've made it very clear that the ceiling is 75 basis points. I think 100 basis points has essentially been taken off the table now. We heard a little bit about 100 basis points heading into this meeting, but it never really kind of took sail in the way that some of the prior 100 basis point conversations have. So I think we've taken that off the table. I think also with the dot plot only showing a 25 basis point hike next year in the median forecast, I think that also kind of means that we're fairly priced at this point. So I mean, if you look at kind of where front end yields are, we're essentially pricing most of those hikes very accurately that the Fed has projected. So unless we see again some continued upside surprise in CPI, another really big print, or if we see Fed speakers come out and start to suggest that they need to do more 75s. I mean, those would really be the things that would, I think, take those front end yields higher. But for now, I think, we're probably fairly priced for the Fed path that we're expecting at this point.
In your note, you also mentioned that the press conference was only really notable in that Powell largely avoided saying anything notable. It's a job that none of us really envy having right now, being the Fed chair or being on the FOMC. But if there is anything that stuck out to you that was not mentioned that you expected to hear from the Fed at this point in time, what is that? Just so that we know to pay attention to that going forward from here.
No, I think Powell has perhaps learned his lesson a bit after the kind of dovish pivot debacle that we had after a prior meeting.
Do you think that's restored credibility in the Fed?
I mean, I wouldn't go so far as to say restored credibility, but I think it was heartening to see that he did avoid some of these pitfalls yesterday. I think there were points in the press conference where it would have been very easy for him to kind of slip up as he continued to answer the question and say something that markets would have latched onto as something that was particularly dovish. But he sidestepped those landmines. And I think, in the past, we've seen him talk in circles to the point where he says something, markets see that as very dovish, and what we get is exactly the opposite of what the Fed wants, which is financial conditions loosening because now they expect the Fed to pull back. So he didn't do that. And I think Jackson Hole was the first time, we heard later on that he stripped down that speech. He took out all the extraneous stuff and said, this is my core message. It was extremely short, extremely tight. He didn't have any of that kind of fluff around it that would risk markets coming away with that with a dovish impression. And he did the same yesterday.
Yeah, shorter than NFL quarter, for sure. And we expected a lot more at Jackson Hole. So it's extremely measured, it sounds like, that he's going to be going from this point forward. Blake, appreciate the time here this morning. And for the recap, it's RBC Capital Markets Head of Rates and Strategy. Appreciate the time this morning. Welcome back to Yahoo Finance Live, everyone. Let's battle it out in our bull versus bear segment for the week. The spotlight's right now on Nike. Barclays Managing Director Adrian Yee, who just downgraded the athletic apparel brand to equal weight, alongside Evercore ISI Senior Managing Director Omar Saad, who maintains his outperform rating, join us now to make their cases. Okay, so I'm just going to kind of throw the jump ball here, but I do want to start with you, Adrian, because as I look through your notes here, you're looking really at some of the inventory risks and really looking more near term for your thesis around Nike. Kind of break down exactly what you're looking at near term here on the inventory side, and is that something that can be navigated through to get them into kind of a more bullish stature?
Yes. So the inventory issue is sort of near to medium term. We actually think from a kind of broader perspective, wholesale in general tends to follow frontline retail being those who sell directly to the consumer by about 6 months. So we always say that, frontline retailers will buy the out season to the rate at which they sold through the current season. So we think there's going to be a really, really tough holiday. And part of this is really about the forward 2023 purchasing behavior in the wholesale channel. Remember, Nike still has about 55% in the wholesale channel, even though they're making great strides in moving to DTC. So that's sort of the crux of kind of the near to medium term.
And Omar, just kind of staying on that same thread of inventory as of right now, I mean, you've sent us some interesting stats on particularly this sneaker super cycle here more broadly. Break that down for us and what we need to know about where Nike is sitting right now in that sneaker super cycle. I haven't had any issues trying to find the drops that are the latest and greatest, and perhaps that might be part of the issue in this near term that really feeds into the bear case.
Yeah, no, thanks for the question. Thanks for having me. Hey, Adrian. Look, inventory is a result of supply and demand. And as you know, we've come through a very strange supply period with everything ranging from factory shutdowns to port backups. And so Nike, along with many of the companies we cover, especially heading into the heavier back to school fall holiday season in North America, bringing in inventory early to avoid the kind of supply backups that have been happening the last couple of years. I think 65% of their North America inventory is in transit, what was at the close of the last balance sheet. I think you back out some of those extraordinarily high in transit numbers, and the inventory levels start to look more normalized. And again, I think you pointed to the right equation. We are in the beginning of a sneaker super cycle. There's this perception that sneakers have been booming for the last 3 years, and the reality is, you do a deep dive unit analysis, as we have in some of our recent research we sent you guys. There's been a dip in unit sales, even with the rise of all the new sneaker brands. We think there's still a lot of demand out there. People are wearing sneakers more. They're wearing through sneakers more. Their feet are absolutely used to the comfort that sneakers and other comfortable footwear brings during COVID, and are hesitant to go back to uncomfortable dress shoes on a daily basis just for special occasions. And they want to own more sneakers in their closet for different wearing occasions, not just to wear to work or to wear for workout. Sneakers are kind of almost becoming a highly specialized accessory, and Nike, we think is the best positioned company to take advantage of this massive sneaker super cycle. Say that fast 3 times.
Exactly. I want to shift gears and talk particularly around the world here, where we're looking at some of the relative strength that Nike may have in some regions versus others where, Adrian, you've laid out that China still remains a near-term volatile landscape and a longer-term question mark here. How long do you believe it'll take for Nike and some of the other footwear brands, quite frankly, to really work through that volatility?
So the big question here for Nike in China is kind of the algorithm used to be sort of low to mid-teen growth on a CAGR basis, and they would, just every year beat that, right? So they were sort of more on this 20% plus. No one expects them to return to that, but we're really looking for them to return to positive growth. That could actually happen in the next couple of quarters. What we would say there is the landscape. There's a big question mark as to whether this is just sort of a short to medium term COVID transitory issue, or whether this has more of a bent toward sort of the rise of domestic brands, right? So the two kind of equivalent Chinese brands would be Li-Ning and Anta. And if you look at their first half yearly numbers, Li-Ning was up 22%, Anta was taking share, up 14% in the market. You compare that to Adidas, down 35%. And then for the first half of the year that we know of from Nike, down 12%. And so we think that this is a very sort of kind of uncertain time period. The good news is that upon the reopenings that we've seen sort of in the back half of September, you have seen a resurgence in their DTC business, the direct-to-consumer business. Adidas is taking about 400 million euro or $400 million worth of inventory back, right, out of that channel. So they're reversing forward sales. There's just quite a bit of inventory, a lot of promotions in that China marketplace.
From one of the very real marketplaces, the IRL marketplaces, if you will, in Greater China, to one of the budding ones in the metaverse, which I know is part of your bull case, Omar. I mean, when does that actually become reality to a really contribution portion of what Nike's future growth may look like?
Thanks for the question. I do agree with Adrian that China is a near-term risk, but I think there could be a big boom in China when they reopen, and the higher-end brands tend to win in that exuberant environment as we saw in North America and Europe over the last 9 months. But I also think Nike has a huge opportunity globally to sell what are effectively virtual shoes. The blockchain technology really is a transformational technology for these types of products because it can ensure the uniqueness and the rarity of these types of virtual products, frankly, in a way that you could never do with physical products. A physical rare a shoe on someone's foot could always be a fake. You can't be sure. With blockchain technology, if I have one of the 10 rarest XYZ shoes, with blockchain technology, I can prove that with absolute certainty online. And the other thing I would say is, the rare shoe collectors, which Brad sounds like you might be one of those sneakerheads. A lot of those really rare shoes that they do collect, they never get worn because it ruins the value if you wear them. So in reality, they're kind of already like virtual shoes. And if you can bring that kind of rarity and uniqueness and cool factor to a much more mass audience at who knows what price point, some of the most rare ones will be very expensive, and some of the more common ones I think will be less expensive. So people to use them with their avatars, it could become a very scalable, high revenue model with really high margins, obviously, because there's no physical cogs in those products.
Omar, rare air or not, I wear the shoes. I'm sorry. I don't know how people buy these shoes and just let them sit on the shelf to resell at some point. That's great, but for me and my house and myself, perhaps, I'm going to be wearing these rare airs out here. We got to leave the conversation there. Would love to have the conversation in person and have this reoccurring. Evercore ISI Senior Managing Director Omar Saad and Barclays Managing Director Adrian Yee. Thank you both.
As the Federal Reserve steps up its interest rate increases, American households will certainly feel the pinch in their pockets, on their mortgage statements, and their car payments. Here to discuss how consumers can navigate these tough conditions and maintain financial wellness is Ellevest CEO and co-founder Sallie Krawcheck. Sallie, it's good to see you. Certainly people are going to see this in all aspects of their financial health, right? The higher interest rates, and also perhaps in their willingness to invest, right? If they are seeing higher costs for things, maybe they want to allocate less to the markets. So I know this is a big question, right? But if you take that 10,000-foot view, what are you telling people about how to think about this environment?
Yes, well, Ellevest is a wealth tech platform built for women, really centered on women, built by women. And we're telling her, you know, this is the time to continue to make your recurring deposits into your investments if you're able to. This is the time not to panic and take the money out of your 401k or IRA if you're able to. And I'll be honest with you, the answer we typically get back from her is, I know you already told us. And so what we're seeing going through this difficult time is women are very concerned about inflation. Something like 77% of women rank it as their top concern. 90+% of boomer women very worried about recession, but they are staying the course on their investments, which is a reason women, when they invest, tend to outperform men, because they do tend to set a plan and stick with it.
Can you lay out for us as well, and I guess just kind of additive to what you were mentioning a moment ago, the reality of what we had seen early onset in the pandemic, and one of the ramifications later on was the she-cession and how employment had been impacted disproportionately for women in the pandemic, and then now coming out of it as we're trying to emerge from the pandemic, but there's still so much work to be done, where women are still trying to make the headway to not only have parity in wages, but also parity in the ability to invest and to kind of maintain some of those wealth building mechanisms.
Right, great question. And we wanted to get really a comprehensive and quantitative look at the financial health of women, the financial wellness of women. And we went out to see, are there any indices out there? Where's the deep research? And we couldn't find a comprehensive index, so we built one, the Ellevest Women's Financial Health Index. And you're right, when you look at its performance over the past, say, 5 years, women's financial health took a big hit during the pandemic because they lost jobs at a disproportionate rate. Improved coming out of the pandemic as they were returning to the workforce, but this year has been tough. Women, everybody's hurt by inflation. Women, because our wealth is only 32 cents to a white man's dollar. For women of color, it's pennies. So inflation hurts everybody, but hurts women more. So women were hit by that, which hurts the pocketbook immediately. But the other thing that women were hit by, which is an economic and financial issue, is the fall of Roe v. Wade, which might not affect them today, but the research is clear that it affects their pocketbook and keeps women in poverty, keeps women from achieving their full economic parity. So with the combination of that and consumer confidence falling and looking into recession, just 14% of women say they are financially prepared for a recession. It is worse for women financially by this measure, by the Ellevest Women's Financial Health Index, than it has been in the past 5 years, worse than the pandemic.
And as we were showing as well, the disconnect that we're seeing, or the different prioritization and concerns among different generations, is also quite interesting. While everybody, of course, is worried about inflation broadly and worried about the economy, Gen X and baby boomers are more worried about that, or they're listing it as one of their top worries, whereas younger women also put, more sort of social issues, if you will, on that list. Reproductive rights, obviously more of a personal issue, I guess, personally affecting issue for younger women. Housing prices, I mean, it makes sense, right, that younger women are more concerned about these issues.
I know. I was saying that the boomers are sort of, there are two ways to, or many ways to read the data, but one way to read it is 91% of boomers, their number one concern is inflation. And part of me says, oh, they're over it, the other stuff. And the other part of me says, no, they've actually lived inflation before and are the only generation of women who we surveyed who have, and so know really how tough it can be in the recession that can come after. But you're right. What was so interesting is these younger women, the Gen Z, the millennials, really knocked back over the fall of Roe v. Wade, really concerned about childcare representation, and in fact, wanting to hear from the companies they work at and the companies they buy from what their stance is on reproductive rights. And there's telling us the majority of millennial women are saying, I would consider leaving my company if our view on reproductive rights does not align. And certainly 2/3 are like, I wouldn't buy from someone if our view on reproductive rights doesn't align. So we see the difference. The one, though, that is across generations, a top 5 financial concern for women across generation, climate change. Climate change broke in the top 5, which I think we often don't think of it as a financial concern. But again, when these things go bad, they hit people in the pocketbook. And if you have less money, they hit you more.
Yeah, and if you are a younger woman as well, it could be an issue for your children, it's a long-term issue. One more thing I want to ask you about, and that is the disconnect between men and women and their number one financial priorities. Men, it's their retirement. Women, it's their family. Is that is that a problem? I mean, it's very sweet on the one hand, right? But on the other hand, is it sort of a problematic thing that you got to be focusing on your retirement?
Well, for sure. And recall, women live 6 to 8 years longer than the man in their life. 80%, by some measure, 80% of women die single. By another measure, when she outsources her money to him and it comes back to her, either because they get divorced or he passes away or something happens, 70% of women have a negative surprise. So my heart, women, their families, but please take care of yourself as well. Please take care of yourself as well. The other difference we saw with men and women, which I thought was really interesting, is men are quite a bit more concerned about stock market volatility and crypto volatility. And women are like, I don't have the time. I do not have the time.
Amen to both of those sentiments, right? Take care of yourself, and I don't have the time for that. Sally, thank you for being here. It's always great to catch up with you. Ellevest co-founder and CEO Sally Krawcheck. Appreciate your time.
Thank you.
CPI, another really big print, or if we see Fed speakers come out